Commissioner Garcia Richard.
Here.
Senator Eichenberg.
Present.
Secretary Debbie Romero.
Present.
Peter Frank.
Yes, I'm here.
Linda Eisen.
Here.
Harold Lavender.
I'm here.
Lee Rawson.
Present.
Michael Messina. Nicholas Paez.
Present.
Tim Jennings. Mr. Jennings had let us know that he was not sure if he was going to be able to join our meeting today. I'll go through staff then. Steve Moise.
Yes, good morning.
Vin Smith.
Present. Good morning, everyone.
Evan Land.
Good morning.
Brent Shipp.
Good morning.
Charlie Woolman.
Present.
David Lee.
Present. Good morning.
Paul Chapman.
Present.
Carla Bennett. Present. Chris Cassidy.
Present.
Clay Camper.
Present.
Clayton Cleek.
Present.
Mikhail Kuznetsov.
Present.
Bruce Brown.
Here.
Nino Carpenito. And then Marcia.
Pardon?
From RBK, we have Marcia, and I'm assuming Matt today.
Yes, all three of us.
From Mercer.
Hi, Richard Pugmire and Amy Ridge are on from Mercer.
Thank you. And Townsend.
Good morning, Seth Marcus and Andrew Bradley today.
From Axia.
Good morning, Jennifer Wildman with Aaron Nessel and Philip Muller.
Thank you. And do we have representatives from Oaktree?
Yes, Talbot Carlton from Oaktree.
Thank you. And Silver
And Bob
Point?
O'Leary.
Okay. Silver Point? Anyone from Menlo? Or Bridgepoint? Are there any participants that I've not yet identified? All right, Commissioner.
All right, very good. So I think I heard 8 members are on with us today. I don't think I heard member Messina.
I did not hear, he did not answer the roll call.
All right, so we do have a quorum, and before I take a motion to approve the agenda, I just want to make sure there are no objections to the consent agenda, because then that would mean we would have to amend our agenda. Are there any objections to the consent agenda at this time? To hearing both of the items?
Can I just ask you, let me ask a question, can I?
Yes, Member Rawson?
Okay, no, I'm fine. I got it. I'm good. Excuse me.
All right, so do I have a motion to approve the agenda as published? Yes?
Well, this is Lee. I just had one question on the opens meeting resolution, that was all. But I think we need to pass it. My only comment was the determination of whether or not we go in. Let me just get that page real quick. I'm just sorry.
So, Member Rawson, I will give you an opportunity when we get to the consent agenda. I just wanted to know if you wanted to pull any of those out as separate votes. That's my question right now.
I don't want to pull it out as separate vote. I do have a comment. That's fine.
Okay, so I will recognize you once we get to the consent agenda. At this time, I'm looking for a motion to approve the agenda as published.
So moved.
Thank you. Member Rawson, do I have a second?
Second, Peter Frank.
Okay, second by Member Frank. Do I have any opposition to approval of the agenda? Okay, all those in favor signify by saying aye.
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 Okay, with that, we have an approval of our agenda. Now we're going to move to our consent agenda, which is the approval of the minutes and the 2021 Open Meetings Act resolution. Do we need to hear from staff, or can I go directly to committee?
I don't believe staff has anything, Commissioner.
Okay, so I have Member Rawson on this item.
But my only observation is on number 9, where it says provision for virtual meetings, is that we specify that as determined by the chair. In other words, it's void on who determines that we need to have a virtual meeting. And I just think the chair should make that determination. We just should have some language, the chair, the governor's committee, the SIO. We need to designate who's going to make that decision. And I'm fine with it otherwise. And I don't care who makes that decision.
Evan, is that something that we could, or Bruce, I guess, Bruce?
Yeah, we could just put something in. If you prefer the chair, or this is Bruce, I'm sorry, if you prefer the chair or the state investment officer, that's up to you. If somebody has a preference, just put that language in number 9.
Well, I would recommend that we change it to the chair, or we add language that as designated by the chair, and then I'm fine for approval.
We'll make that change.
Any further discussion on agenda item number 2, the consent agenda? All right, I'm going to have a roll call vote for this. Or, I'm sorry, I need a motion to approve the consent agenda.
This is Harold. I move approval.
I'll second.
Okay, we have a motion by Member Lavender, a second by
Lee.
Second by Member Rawson. Carrie, would you call the roll, please, on approval of the consent agenda?
Commissioner Garcia Richard,
Yes.
Secretary Romero,
Yes.
Treasurer Eichenberg,
Yes.
Peter Frank,
Yes.
Linda Eisen,
Yeah.
Harold Lavender,
Yes.
Lee Rawson,
Yes.
Nick Fayette,
Yes.
and I'm just checking, Mike Messina, have you joined our call yet?
Yes,
Thank you.
I vote yes.
All right, thanks. Nick. The motion passed.
Very good. And on to agenda item 3, over to you, Steve.
Thank you, Commissioner, and good morning again, everyone. Taking a look, if you would please, at the State Investment Officer report. The current net asset value, as reported by J.P. Morgan this morning, is $27.561 billion. West Texas Intermediate is showing $40.60 per barrel. Secretary Romero, you may want to correct me on this, or Commissioner, but I believe the state is budgeting for FY21 at $27.22 per barrel net. Distributions over the past 12 months have been $1.009 billion to the state from the funds. Our tax stabilization reserve as of May 31 was $1.163 billion. We received $30 million in June. We expect 2 or 3 more inflows to that fund, and Brent may have more to say about that as we get to his report. Briefly on the New Mexico Recovery Fund, we have several sectors of the economy that are included in the applicants for these loans. We also have good geographic dispersion. 15 loans are either in the final steps of due diligence or have been funded. A low number has been funded because many are in the final stages of review by council. There is about a $70 million pipeline in place. All of you, I think, are aware that we have no council or committee meetings scheduled in July. We do skip 2 months each year, July and December. Under operations, as all of you know, we continue to work remotely. In connection with that, your staff has promulgated some COVID-19 protocols in the event that people need to come into the office, and those are available for anyone on the council that would like to see them. They have been published to staff. Under external relations, the House Memorial 9 Working Group, that's the Renewable Energy Strategic Plan, is in process. Bruce is leading that for us. As you know, we are awaiting the RETA report that is being prepared for them by the ICF organization. As soon as we receive that, and it's expected imminently, we will reconvene the working group. And that report will be distributed to members of the working group and to the council. I'm going to ask Charlie to fill you in on the outcome of the special legislative session as it relates to the funds. Before I do that, let me just mention that Highlands University Foundation, as you know, has asked to become a client of ours. And thank you to Secretary Romero. The Joint Powers Agreement has now been signed, is in place, and we expect to receive those funds July 1. Charlie, would you fill us in on the session, please?
Sure. Thank you, Steve. So really, there was one bill out of the special session legislation that was considered starting last week that impacts the SIC directly. In their final day of work and then the final discussion of that last bill, the House did pass Senate Bill 3 yesterday. It is headed to the governor's desk with an emergency clause. This bill instructs the council to appropriate $400 million to the New Mexico Finance Authority for the purpose of low interest small business loans. Those loans will be issued by New Mexico banks, credit unions, and alternative lenders, then will be repurchased by the Finance Authority. Repayments will eventually flow back to the Severance Tax Permanent Fund. The loan terms are no more than 5 years with an interest rate of half of the prime rate. That's about 1.6% currently. Loans are for businesses with up to $5 million in revenue down to small sole proprietorships. No collateral or personal guarantees are required to secure the loan, but lenders can run credit checks and will work off of existing relationships to a high degree as they can. The loans can be up to $75,000 each, and there's a metric that determines that amount based on what they paid in taxes the previous year. Loans cannot be forgiven, like the PPP program, and New Mexico nonprofits are also eligible for these loans. They'll provide an additional 1% of the severance tax 5-year rolling average, for about $50 million, for 2% interest loans to local governments, cities, and counties. There is also a measure on this bill that will help keep business unemployment payments low for businesses temporarily. This was the last piece of legislation that lawmakers tackled. They, after a 26-11 vote in the Senate and several revisions, the House members yesterday in debate the ones who had concerns about loan defaults or other aspects of this bill generally said they were more concerned with the risk of not doing anything. And that crisis situations like the one we're in sometimes require untested strategies. So the House passed that measure 59-5. It will become law as soon as the Governor Lujan Grisham signs it, as she is expected to. Members, any questions? Go ahead.
So Steve, could I take questions from committee at this time? Are you finished with your presentation?
Yes, I am. Thanks, Commissioner.
All right, so committee questions for Steve or Charlie?
Yes, this is Linda.
Member Ike.
Where will we be taking this money from? What asset class, and where do we have this liquidity?
Vince, can you respond, please? Go ahead, Charlie.
So, Linda, this is Charlie, and the bill prescribes that we take it out of the liquid portion, meaning stocks and bonds, essentially. Vince, I think, will, and the council will determine exactly how that will go, but it is limited to the severance tax permanent fund.
Vince, do you have any comment on that?
We'll have to look, Member Eitzen, where we're sitting at the time the money needs to come out. So if we took it out today, we could get a good spread of stocks and bonds for certain. It just matters where the markets are at the time, when the money will have to come out. And we'll obviously be bringing you a proposal for that to look at.
Also, I have a question. Does this mean that the term of this program is 5 years, and that during that 5 years, any payoffs of the loans will be returned to the severance tax fund, and so at the end of 5 years, we will have everything back that we're going to get back, or how does it work as loans get paid off?
Linda, this is Charlie. I think that's a fair assumption that the loans will be repaid through New Mexico Finance Authority, and then ultimately come back to the severance tax permanent fund. There are some little details that probably still need some determination.
Any further questions?
This is Lee. I've got a question.
Member Olson?
Charlie, does it say anything in there about how the banks or the other lenders are going to get compensated?
Member Watson, that it does allow for processing fees. It does cap those. And so, there's a limitation, I think, on 2% of the loan as a processing fee. So if it's a $75,000 loan, the banks could charge up to $1,500 just to process it.
Thank you.
Anything further from committee? Okay, with that, we're going to go to item number 3B, CIO report.
Thanks, Madam Chair, and I'll be short because I've set you up quite a busy meeting today in terms of performance reports and investments. We're not in much different position than we were the last time we met. Lots of the individual pieces are moving around, but overall, we're still roughly in the same spot, and that is there's still a large disconnect between what the financial markets are doing, in particular risk assets like stocks, and what's happening in the underlying economy. So we're still seeing a great deal of weakness in the underlying economy. We thought somewhere between -4% and -5% annualized for the first quarter. It came out to be 5.1 minus for the first quarter. We're still expecting kind of -35, maybe even -40 for this quarter, for the June quarter. That's what the economic models of the economists that we follow most closely are saying. And so we'll see here in a few weeks how those numbers come out. So a great deal of weakness still in the overall economy, both here in the United States and globally, but not reflected, it doesn't seem like, in the stock market. So a lot of the talk is, well, you know, stocks are looking past this into a recovery and so forth, and pricing that. Data's come out from the Congressional Budget Office, the CBO, that we likely won't recover for 10 years, the GDP that we've lost, at least here in the United States. So the market's crystal ball is 10 years now, it seems, if these prices are right. So we're a little bit nervous about where stocks are trading. NASDAQ's near or at all-time highs. The S&P 500 is just a decent year's return away. We're up a little bit today, it looks like, after being down last week a little bit. So we'll see. We're still hanging in there on a conservative basis, you know, relative to long-term risk-taking that we normally do over a full economic cycle. We're still quite conservatively positioned. In terms of opportunities in the markets, we're still focused in the credit sector. That seems to be where there's opportunities, and you've got two investments today to look at in that space that we'll be talking about later. And so I think that is kind of a wrap. We're just sort of moving on toward the fall, where a lot of folks are expecting a sort of a second round or a second wave of the COVID virus. So we'll see how markets and the economy weather that. But again, we're conservatively positioned, lots of liquidity, looking for opportunity, mostly finding that in the credit space. So with that, Madam Chair, I'll take any questions that the council has.
Thanks, Vince. Questions for Vince? Nope. All right, we'll go to Vince and RVK for the performance report.
No real comments there for me. Let me turn right over to Marcia to go through our latest numbers.
Okay, good morning. Well, this is just an April flash, so monthly flash report. I think we mentioned preliminary numbers, but I just want to take you back to the end of last quarter, just remind you where you were at the end of the first calendar quarter. Not to bring up bad news, but the return on a net of fees basis for the first quarter was negative 9.74. And just a reminder that on an absolute basis, that was terrible. But you did much better than most of your peers, again, ranking definitely in the top quartile compared to your peers. In April, we saw improvement in the market. If you go to page 25, you were up 3.98 for the month. That puts your fiscal year-to-date number in still in negative territory, but not as negative as it was. So for your fiscal year, you were down 1.28. You'll see also, if you look down below at the land grant and severance tax, that you actually had a nice month on a relative basis, beating both of your benchmarks. So the things that were headwinds in the first quarter where everybody wanted to be within treasuries and any kind of, especially in fixed income, any kind of non-treasury underperformed. So your fixed income composite suffered due to lower duration and the plus sectors for that quarter. And we'll talk about that just ever so briefly in a moment. I did want to take you to page 26. This is looking at the asset allocation for the various funds. I wanted to point out on tax stabilization, you'll see off target a little bit. That has or is being corrected. So that next report should show in line with its target. Page 27, just pointing out, we're talking about the severance tax total fund. We showed third grouping down. You can see the severance tax, which had cash net outflows on the calendar year of over 47 million, and due to the market, also suffered investment losses like most other funds. Page 28 is looking at composites. I'll just say a couple words here. Again, outperforming for the month your benchmarks for land grants and severance. Starla's going to talk to you about the equity, global equity trailed, and that all came from U.S. equity. And as I said, Starla has some recommendations later today. On the fixed income, you'll also see that you underperformed your benchmark, but that, if you look down below, you'll see that came from your non-core fixed income. Actually, your core fixed income that had trailed for the first quarter had a nice bounce back, beating the ag. Again, the two managers that had plus sectors came back nicely for the month. And then your non-core fixed income, it looks like a dramatic outperformance relative to the benchmark, but I just want to remind you that benchmark is lagged 1 month. So what we saw in your performance for fixed income in March, the benchmark is now caught up to that. So again, I know Mikhail is doing some research on benchmarking as well, not to make it, just to make it a closer match to your non-core structure. With that, just say that it was a good month, a nice comeback. Preliminary numbers for May are looking are positive as well, around 2%. So could have a fiscal year to date that is now positive as of May. So we'll have those numbers for you next time. We'll take any questions.
Marcia, this is Linda. I have a question for you on your page 6, our diligent page 29, and it has to do with the real return numbers. We have one real return composite, and lower down we have financial real return composite and Townsend reported real return. Is that Townsend reported real return, real assets, or real return? I'm trying to figure out why it's a different number than the real return composite.
What, Vince, were you gonna?
Member Exton, the Townsend reported real return is our non-publicly traded assets aggregate. So the financial real return composite is mainly the MLPs. But Townsend just reports our non-public markets assets.
Okay, which used to be primarily the real assets, but now we have a category in financial that would be
you always had financials, and it used to have, some of that came out and was, now it's just the MLP portfolio in your financial assets. It used to be, there used to be more in financial assets, but those were moved to other places in the portfolio. So right when that is just the MLPs for financial real returns.
Okay, then I have a question for you on our attribution. Suddenly those attribution charts look kind of weird. Style selection is showing on the 1 year as being very much outperforming. And again, on the 1 year, on the severance tax, the manager's skill is dramatically underperforming. Suddenly these attribution charts look very different than they did before. If you could kind of explain those.
If you look down below on the 1 year for land grants, and you'll see that the outperformance there for the 1 year is coming from your non-core fixed income. And so that really is a benchmark, I don't want to say a benchmark issue, but there is no perfect benchmark for non-core. So that is affecting how this looks. I guess the takeaway from this, we know it's not perfect, but the takeaway from this is, that really asset allocation does drive most of your performance here, but this is a benchmark issue that we're trying to correct, and we will correct.
Yeah, I noticed that. Mm-hmm.
Matthias is the one that helped create these charts. Matthias, did I miss anything there?
No, not really. I think the divergence between the composite and the benchmark is so wide that it's overwhelming on the short term. I think under more normal market environments where you don't have the type of volatility that we've seen over the last year, you would see that absolutely to your point, Linda. You would see that a much smaller part. But when you have substantial market dislocations, you can certainly see that. I wouldn't read into that too much. It's somewhat indicative of just the difficulty of finding a good investable benchmark for things that aren't traded and priced all that frequently. So there's going to be some inherent mismatch. But typically we would expect it to revert back to more normal size bars as you're used to seeing.
Okay, and again in the severance tax, with the underperformance coming from manager skill in the private equity, that's the New Mexico program primarily?
Absolutely.
Yes, okay.
That's right.
Thank you.
Further questions for RBK? All right, we'll go to Paul and Townsend for our fourth quarter 2019 performance report on the real estate asset class. Paul?
Thank you, Madam Chair. Paul Chapman here, and I'm going to kick it over to Seth in a second, but as you'll see on page 51, returns in the fourth quarter were really strong across the board. We're very happy with that. I'll forewarn the committee that real estate prices have come down. This is sort of ancient history now. Pre-COVID, think about real estate returns kind of being down, or real estate values, I should say, being down 10% across the board. Multifamily industrial being down the least, things like hotels and retail being down the most. But in aggregate, the thinking is that prices are down 10%, even though there's been very little trading activity. The other thing I want to say before I turn this over, we're sitting here in March, we're sitting here in June, we're reporting on fourth quarter 2019. That's because our managers get extra time to do their year-end reporting because of audits. So that's why this report is always delayed. The end of year report is always delayed. With that, I'll kick it over to Seth to take you through the report quickly.
Great. Thanks, Paul. And maybe quickly before I go into the report, I'll address your question, Linda, about the Townsend Index versus the in RBK's report. So as Paul mentioned, this is fourth quarter performance. And when we provide data to RBK, it's always a quarter lag. So when you look at the real return, the Townsend reported real return numbers, it says a 0 for month to date, quarter to date, because we just don't have the April or the first quarter data to provide. However, the financial real return composite, given that MLP public exposure, you have current returns in there. So that's why it's broken out the way it is. But I'll jump back to the real estate report. So as Paul mentioned, we start on slide 51. I know this came up last quarter when the private equity was mentioned or presented, but obviously this is year-end reporting. To Paul categorized it correctly as it's ancient history. The world obviously drastically changed about 2/3 of the way through the first quarter. So even the first quarter performance, which we'll report at the August meeting, won't fully reflect the post-pandemic environment, given it's only about a month of performance from the first quarter. However, in this report, the fourth quarter data, for those that recall or newer members, we do include a full two-page or a full page summary of every individual investment within the portfolio. So their books, although it's electronic likely, is a little bit longer than it has been in other quarters, and those are referred to in later sections. We won't go through those page by page, but they are there for your reference and if you have any questions. Also, we included a 2-page market update, and that's through June 5th for this report. on slides 68 and 69 of your presentation. We share this with your staff on a bi-monthly basis. We're trying to keep the staff and you all engaged and give real-time information given things are changing on a daily basis. On that topic, and what I did for the CIC meeting, and I'll do the same here, is provide a bit more of a market update, given this performance is pretty dated. And I'll refer to a couple slides at the end, but I just wanted to talk about the real estate market and how it's been impacted, and where we see the opportunities and distress, but as well as some pain within the portfolio. So much of what I may say in the beginning won't be new to some of you, but the assumptions on the timing and the normalization of an economic activity or recovery continue to be wide-ranging. Many believe that it's already occurred. Others believe that later this year and into 2021. Really, the monetary and fiscal policy response across the world has been extreme, rapid, and obviously unprecedented in size. So the major central banks are aggressively engaging in quantitative easing, and their balance sheets are really projected to really grow by trillions and trillions of dollars, which is helping to maintain the markets today. Speaking specifically to real estate, so while the current crisis is really first and foremost a global health issue, it will take its toll on the economy and on real estate going forward. So it may create longer lasting impacts on supply chains, on global connectivity, on demographic and sociological preferences, financial markets, including inflation, interest rate, and asset class repricing. So real estate repricing is inevitable. It's occurring, as Paul mentioned, but likely very different from sector and based on markets. So the public market evidence suggests, and as does the private, that hotel and retail, as well as senior living, will be the most impacted, while industrial and multifamily and some of the other alternative asset classes are relatively more insulated. Slower and uneven recovery, market differences, really shift in secular trends and changing market mindsets should provide investing opportunities over the next several years. As we have over the last couple meetings, we've made some new commitments to blind pool or very limited seeded portfolios, and that's where we really do see a difference this time around versus the global financial crisis. In 2008, 2009, a lot of investors, institutional investors, were nervous and took their foot off the gas and did not make new commitments and really missed out on some of the most attractive vintage years, and that's what we're trying to avoid at this point in this cycle. Specifically, sector by sector, I'll just give a quick sentence or two on each one. In the industrial sector, the deglobalization or protectionism trend, which was accelerated with recent trade wars, is likely continuing due to the COVID-19 pandemic. So what we're referring to is countries are seeking to really reduce their external dependence on the critical products, right? Supply chain components, so healthcare and technology. This could result in stronger levels of demand in the local and regional industrial production clusters. And as we position the portfolio over the last year, New Mexico, the SIC portfolio here, is overweight to that industrial sector. Secondly, in the residential sector, there could be a slowdown on the rate of urbanization as preferences may shift to lower density, more suburban living options. For those who dialed in a few minutes early, there was a conversation about people moving from the East Coast to spread more across the U.S. and that's the type of opportunities that we're seeing. And even so, really avoiding the CBD in some locations and moving a little bit out to the suburbs. The residential sector, there could be a slowdown in the rate, as I mentioned, in urbanization. So it's shifting to really lower density locations. And then in the office sector, the de-densification trend, so a reduction in co-working demand, increased work from home models, is really going to impact the demand for office going forward. Tenants are likely to increase their focus on health and technology as a key amenity for their employees. It's not just going to be show up to the office, but really show up to the office and maintain the focus on health. The two sectors obviously going to feel the most pain, retail and hotel, hardest hit and likely the longest to recover. Again, we're seeking to be underweight retail, overweight both residential and industrial. So this and underweight hotels as well. So positioning the portfolio over the last couple of years to really follow these trends going forward. But longer recovery due to retail bankruptcies, a change in shopping, travel preferences. And then across all of these sectors, really location will become even more important than in the past few years. So in up markets, in a rising tide, this all ships type environment, yields tend to converge, and in down markets, they diverge. So the focus going forward will be on tier 1 locations, primary markets, as well as some larger tier 2 markets. Many of the core funds, so speaking to your portfolio specifically, are well leased in the 90% range. The challenges of the pandemic and the crisis have resulted in very large rent relief requests from a wide variety of tenants across all those property types. This is going to result in a reduced NOI in the near term, so especially in those hotel and retail assets, as managers really manage for the long-term tenant retention and property value. So rent relief requests are being evaluated on a case-by-case basis for each and every manager we've talked to. And to give some numbers behind it, April through June, so near-term rent collections are really mixed across property types. So when we look at multifamily and industrial, it's in the high 90%, 95, 98%, in some cases a full 100%, depending on the quality of the tenants. Office also in the high 80% range, 80 to 85% range. That's consistent across most office sectors. And then shopping malls, where we do have exposure and we will feel pain, is really in that 30% range. So many businesses are struggling to remain solvent, and lease payments are really one of the most significant portions of their financial liabilities. Encouragingly, when we speak with managers, many commercial landlords are working with tenants to help bridge the gap, take a position of we won't put you out of business. If you'll stick with us, we'll stick with you. As such, we're hearing of examples of really trading short-term rent relief, short-term NOI decreases for long-term lease modifications and extensions, including rent escalation. So just an example I heard yesterday from a manager who's providing 3 months of free rent, however, extending a term for 3 more years with rent escalations in that lease. The last point I wanted to make, and maybe I'll just jump over to the presentation here, is to elaborate a little bit on slide 51 that Paul mentioned. So the graph here, we've shown this before, prior performance in prior presentations. The 4Q19 quarter was one of significant outperformance, 80 basis points when we look at the total portfolio versus the index. This is driving strong outperformance over the long term, so we've got a lot of tail in here within the portfolio, although we do anticipate write-downs in the next quarter. So in 1Q, the Odyssey, our index, our benchmark, posted a 1% gross return, about 75 basis points net return. Appreciation was actually flat in the first quarter, and income was slightly positive, so that got you to the 1% return. The reason that first quarter return is still positive despite the market in March was much of the appraisals are done in about 2/3 of the way through the quarter. So come March 1st, most appraisals and almost all of them were completed for valuation purposes of the portfolio. In some cases, specifically hotel and retail, they were reopened, reevaluated, and marked down. But the full extent of the impact of the repricing will really be felt in the second quarter. So it's obviously second quarter still has about 7 days left in it. The guidance we're seeing from managers is a negative 7% valuation decline, offset slightly by income. So not surprisingly, again, retail and hotel valuations impacted to the degree of about negative 15% in valuations, with apartment and office in the negative 5% range. And then industrial and multifamily can be anywhere from 0 to flat, really on a valuation basis. And then the last point I'll make, or the last slide I wanted to talk about here, is slide 52 of the book. We included this just last quarter for the first time. It helps put some context into the historical returns over cycles. So the graph here on the left shows the annual income and appreciation for both the Odyssey index as well as our portfolio. And I look at this and see 2 significant takeaways. So New Mexico's outperforming the Odyssey on an annual basis, year in, year out, since 2013. It was really when that rebalanced portfolio, the new commitments made, started generating significant returns in income and appreciation. Secondly, if you look at just the income associated with the Odyssey, so that's the first bar there, even during the 08, the 09, the GFC periods where you see significant valuation declines, the income never turned negative. So this is a reminder that real estate is an income generating asset class given the collection of rents associated with owning hard assets. This is a metric we closely followed, as I mentioned, the rent collections from each of the managers. Lastly, on this slide, the since inception returns on the right-hand side of the rebalanced portfolio has stayed close to Odyssey from an income perspective. You see the 4.5 versus the 4.8%. While outside depreciation returns, this is really driven by that manager and sector selection that we've experienced over the last 10 years. The since inception total portfolio income was impacted with very limited income, limited core exposure at the onset of the portfolio, really from 05 to 11. But you still see the total return really in step with the since inception benchmark. Outside of those two slides, there's a lot of other information here. I know it's a full agenda, so I'm going to stop here and just see if there's any questions I can answer.
Thank you, Seth. Questions from committee? All right, with that, we're going to go, yep. With that, we'll go to the next performance report. Yes.
Yeah, I'm sorry to bother you. This is Tim Jennings. I'm sorry I'm late, but I had to be with my doctor, talk with my doctor. So anyway, I'll be here as much as I can be here, and then today.
Welcome, Member Jennings. Did you have a question for Seth or Paul?
No, I just, my arm I had surgery yesterday. My arm really hurts, and they gave me hydrocortisone or cortisone, and anyway, it doesn't, I'm allergic to it or something. I can't take it, so I'm all screwed up. But I'm here listening because I can't get anything fixed until later today.
Thank you. Thank you for joining us.
Okay.
All right, we're going to move to agenda item 3E, the performance report, our real return for fourth quarter 2019. Dr. Paul.
Okay, thank you again, Madam Chair. Paul Chapman here. The main thing that I would just look at is on page 144 of the diligent book. There's a graphic in there that I think really tells the story of where we've been successful and where we haven't been successful, and this will inform our future capital commitments. In fact, it already does. Infrastructure over the last 3 years has given us a 11.5% time-weighted net return. It's been a really reliable, stable source of return for us. We love the space, and you'll see us doing more commitments there. Timber ag have been sort of broadly a disappointment over the 3-year time frame. Energy is quite volatile, but it's actually contributed quite a bit at 8.2% over the last 3 years. So expect to see our future energy investments more in the renewable space, less in midstream, less in upstream. But that's sort of the return picture, we look at to help inform our investment decisions. And with that, I will kick it over to Seth again to quickly go through the real assets report.
Thanks, Paul. And I promise to be even more brief here. So the first two slides, as a reminder, is really the real return portfolio, including the real assets. It includes the MLPs and some financial assets and debt investments that are starting to fund. I just want to direct everyone to page 139 of diligent. There we show both the real return performance as well as the total real assets performance. So the second bar excludes the MLP performance. So you'll see there in the 1 year return, the MLPs did outperform or drive some additional outperformance and again, this is as of fourth quarter versus the total real estate. Again, this is the volatility that we're seeing in the MLPs. So to give some context around that, and not to bring up bad memories again, but in March, so again, when we see the March performance, much like your equity report that was presented a couple of months ago, the MLP data for 1Q, the portfolio was down 50% in just the first quarter. So we'll see that impact on the 1Q report. And then we anticipate or hope to see a bounce back here in the second quarter. So just in the month of of April, they were up 32%, and we anticipate, another bounce back here, given where the public market volatility is taking us. But with that said, I'll focus more just on the real assets for a couple slides. And as outlined on really page 141, 2 new commitments were made during the fourth quarter. One was a co-investment alongside of previously approved funds. Importantly, and subsequent to quarter end, we made 3 new fund commitments, both to Carlyle in the energy sector, Icon in the infrastructure, and then IPI Partners, which was the data center fund. These 3 commitments, and you'll see they're segregated a bit from the fund versus the co-investment, but these 3 commitments total $280 million, and really are targeting the allocation that Paul just mentioned, really focused on that infrastructure and energy sectors, as well as that IPI fund that looks at data centers. So a little bit more diversified, creating some interesting dynamics across the portfolio to help drive that performance going forward. On slide, I'll skip ahead actually, to slide 143, also shows performance here, performance returns on an annual basis. You will see that 2019 did result in a slight underperformance relative to the RVK expected return for the year, about 90 basis points. This 1-year performance was impacted by the movements in energy as well as agriculture, as Paul mentioned. And infrastructure really continues to drive and outpace returns. Infrastructure for the 1-year period delivered almost a 10% net return, while other sectors sort of brought the return down. The last point I wanted to make, and Paul sort of addressed it on 144, showing our 3-year attribution case, the 6.3% total return over a 3-year period, with infrastructure and energy consisting of the majority of the return, given the higher allocation, but also the performance of those sectors. Agriculture still being a detractor, and I will say it's still a bit in the J curve. There's also currency being impacted by our agriculture investments, and really limited value created. But we did see, and we discussed it much last quarter, lower demand from ex-US, from the export market has impacted that return. Timber slightly positive, also feeling similar impacts, but we anticipate those being less correlated to the current market environment and providing some relief from some of the volatility in the energy sector. I'll stop there again, given the full agenda, but happy to address any questions. We also do have pages in the back of this portion of the presentation, a single slide on every one of your individual investments for you. I think they start on slide 162.
Great, thank you, Seth. Questions for Seth or Paul? All right, with that, we're going to move to agenda item 4. So we've got 8 voting items before us today. I just want to remind the presenters to be succinct and judicious about their time so that we can make sure to address any committee questions we have. And with that, I'm going to turn it over to Chair Eisen.
Good morning, everybody. First of all, I want to say how pleased I was to have additional SIC members at the investment committee meeting this last meeting. Commissioner Stephanie Garcia Richards was present, Lee Rawson, and new member Secretary Debbie Romero attended the investment committee meeting, and that pleases me very much, and I certainly welcome anybody else to attend those. The meeting was lengthy, as you all well know, because we have the same material today for us, so it was a very lengthy meeting. I also want to give hats off to everybody. I have been on the SIC since 2012, so I am familiar with the format of all the materials, and I'm familiar both as my experience with the SIC as well as being a retired investment professional and attorney. I'm familiar with these terms, with these types of investments, and it still took me many, many hours to get through these materials. And I'm retired, so I really have to commend all of you for walking through these materials for our meetings. Cutting to the chase, all of the investments that are on our voting agenda today were recommended by the investment committee for approval from the SIC. There was much discussion had over many of these investments, and again, I welcome members of the SIC to attend those investment committee meetings to hear those discussions so that they understand how well they have been vetted before they come to you. So with that, I will pass it on to the next item.
Great, so we're going to start with our first voting item, and that is Paul is going to take us through rescinding the redemption request from Berkshire.
Thank you again, and for the last time, Madam Chair, Paul Chapman again. We have an $88 million investment in the Berkshire Multifamily Income Realty Fund, and about a year ago, we submitted a redemption request. We came through the investment committee and got approval to redeem. And the issues that we were having at the time were Townsend had re-underwritten the fund and they were forecasting below benchmark performance. There'd been a lack of capital raising. And I think the biggest concern for me personally was the inability of this platform to get to scale. What's happened since then is that Berkshire and Townsend have been working together to create a way to go forward for this fund. And the way we get redemption proceeds is really one of two things: property sales or new capital coming in from new investors into the fund. Well, new capital has really been stalled, both because of COVID, but also because of this the redemption queue. New investors don't want to be taking out old investors and satisfying their redemption request typically. And then property sales market has slowed down considerably. And we wouldn't want these properties to be sold in a panic. We think they ought to be optimized and allow rents to recover from whatever impacts there is from COVID. So our notion is to rescind our recommendation, I should say, is to rescind the redemption request and stay with this fund. We'll be locked in for 18 months. But in exchange for that, we'll get a fee break to the extent that the fund underperforms its benchmark. And that'll be calculated on a quarterly basis. So we end up with a quite attractive fund fee in the quarters that they underperform and a market fee where they meet or beat their benchmark. So I think that's really all I need to say on this. I recommend your approval. I think it's definitely, as Seth was showing as he was going through the real estate PMR, we are under allocated to multifamily, which is a sector that we're trying to build up and get over allocated relative to our benchmark. So we think this will help, along with some of the other things we've done in the way of new commitments to Cortland, Bell, FPA. All of that will get us to where we want to go in terms of building up our multifamily portfolio, which we see as being one of the two strongest sectors going forward in the future here. So with that, I can open up to questions for Stephanie.
Any questions for Paul on the recommendation to rescind the redemption request from Berkshire? Do I have a motion on agenda item 4B?
Madam Chair, this is Linda Eidson. Based on the recommendations of the Council Investment Committee, Real Estate Advisor Townsend, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve to rescind the full redemption from Berkshire Family Income Realty Fund, as discussed, reviewed, and memorialized by the Council today.
Second, Harold.
Okay, we have a motion from Member Eidson, a second from Member Lavender. Any discussion on that motion? All right, I'm going to go to Carrie for a roll call vote.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Peter Frank.
Yes.
Linda Eidson.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
And Nick Payas.
Yes.
A unanimous decision.
Very good. Okay, so with that,
Thank you very much.
that item passes. Thank you, Paul. All right, so I'm going to go to the first investment voting item, agenda item 4C, And what I'm going to do, Vince, is just hand it over to you. You can call on the folks that you want to from Axia, and I believe we have some Oaktree representatives as well for the entire presentation, and then we will go to questions at the end of the entire presentation.
Sure. Thank you, Madam Chair. And just a couple of brief comments from me. We said at the top of the meeting, we're mainly finding opportunity in the credit space, not solely, but primarily in the credit space. So these next two funds that you hear about participate there. I'm sure you recognize one name, if not both. And with that, let me turn it over to Mihail. He can brief you very briefly on how these should fit into our fixed income portfolio, and then over to Axia for their recommendation.
Thank you very much, Vince. Good morning, everyone. This is Mikhail Kuznetsov. With us on the line, we have Jennifer Wildman and Axia team, as well as Bob O'Leary, Head of North American Global Co-Portfolio Manager, and Talbot Carlton, Head of Institutional Marketing in the Americas for Oaktree Capital. We would like to recommend a $100 million commitment to Oaktree Opportunities Fund 11. Founded in 1995, Oaktree Capital today is one of the largest global investment management firms focused on alternative markets with over $120 billion in assets under management. Nowadays, we are observing probably one of the best possible environments for distressed debt investing since the global financial crisis for a couple of reasons. Number one being market growth of lower rated debt universe. Specifically, there is 2.6 times as much outstanding debt as there was in the pre-financial crisis era. And number two, of course, is the rapid economic deterioration due to COVID pandemic and oil price shock. Oaktree will be investing opportunistically in debt of financially distressed companies, focusing primarily on those with hard asset values, dependable cash flows, and durable business franchises. Given the current state of the economy, we strongly believe that the fund can achieve a return in the mid to high teens, which is in line with Oaktree's long-term average net returns. Additionally, we would like to note that returns have generally been higher in funds that invested in periods of economic distress and heightened defaults. And the period ahead may be one of the greatest such periods ever, given the widespread economic impact of COVID pandemic and the likelihood of a prolonged recovery. Overall, we believe that Oaktree's distressed opportunities, competitive advantages, such as significant global presence, highly experienced team, established track record, and very powerful investment platform will make it a great addition to our distressed sub-allocation of the non-core fixed income portfolio. And with that, let me pass it on to Axia for their comments.
Thank you, Mikhail. Good morning, everyone. It's been a bit of a busy year for non-core fixed income, and I think we wholly expected it to be when the tides changed. The team has really maintained a strong pipeline of managers over the past few years, and thanks to the asset allocation changes prior to 2020. Fresh capital was available to put to work in fairly short order. So I'm just going to give a quick recap of the commitments made to date in 2020 and kind of how that brings us here today. So we've been much more focused early on the more liquid opportunity set, as well as more steady state income generating asset-based lending earlier in the year. But today's recommendations focus specifically on the dislocation in public and private credit markets, in the stress and distress part of the market, where we believe the opportunity set will increase in the coming months as the market gains clarity on future cash flows and revenues. In particular, we were looking for opportunistic and patient managers with extensive experience, which really brings us to the funds we brought here today. I'll keep it brief and just pass it on to my colleague, Erin Nessel, to provide our views of Oaktree Opportunities Fund 11, and then we can hear from the manager.
Thanks, Jen, and good morning, everyone. We recently reviewed Oaktree Opportunities Fund 11, the next vintage of Oaktree's longstanding distressed debt program. We conducted our usual due diligence process, which included investment due diligence, operational due diligence, and legal doc reviews. We also did several reference calls with various investment partners, service providers, and LPs. And today I'll give you a brief overview of the fund and our findings. As Mikhail noted, Oaktree was founded in 1995. Today, Oaktree employs over 1,000 people and manages $125 billion across credit, private equity, real assets, and listed equity strategies. The origin of Oaktree's distress strategy dates back to 1988, when Bruce Karsh began investing in distressed debt at TCW. To date, the team has managed 4 programs at TCW under the special credit strategy, and are now launching their 11th vintage under the Oaktree Opportunities strategy. The strategy has historically been focused on North America, but Oaktree grew out its European presence beginning in 2005 and Asia closer to 2017. The team is headed by Bruce Karsh, along with Bob O'Leary, who heads North America and is on the call today, and Pedro Urquidy, who heads Europe and Asia. The dedicated team includes 44 investment professionals across regional offices in Los Angeles, New York, London, Hong Kong, and Singapore. But they also have access to a variety of other specialized teams across the Oaktree platform. Just a quick update on their ownership. In September 2019, Brookfield Asset Management acquired Oaktree. In the initial transaction, Brookfield acquired about 60% of the firm and will acquire the remaining 40% over 8 to 10 years. Yet Oaktree Management remains in day-to-day control of operations today. The strategy has an opportunistic mandate to invest across the capital structure, geographies, and in public and private markets, and will target distressed debt opportunities in the US, Europe, and Asia. In the current market, the fund is expected to focus on buying liquid corporate credits and originating private rescue loans to companies in financial distress across industries. That said, the fund is truly opportunistic and could hold a wide range of investments, including structured credit, post-reorganization equities, private equity, non-performing loan portfolios, and distressed real estate. The fund is expected to be well diversified across 85 to 100 names with an average investment size of 150 to 200 million. The primary terms are as follows. The fund will target a $15 billion capital raise with a first close on July 1st. The investment period will be 3 years and the harvest period will be 7 years, though the GP has a number of extensions to allow them to dispose of certain assets. In terms of the merits that we see of the strategy, we think the key merit here is really the size and scale of the Oaktree platform. The fund benefits from a large dedicated team as well as access to deal flow and synergies from other asset class specialists across the platform. They have a track record dating back to 1988 with a team that has invested across multiple cycles. And that track record has been good overall, especially during times of dislocation like in the current market. Lastly, Oaktree and Brookfield are committing $1 billion from their balance sheets, which demonstrates strong alignment of interest and their conviction in the strategy and the opportunity set. In terms of the considerations and risks, I just mentioned that with target capital raise of $15 billion plus potential SMA commitments, we do believe the fund size is a bit larger than what is optimal. While we generally like to see managers keep funds at a more reasonable size, we do acknowledge that this size is not out of line with Oaktree's global financial crisis vintage fund and their historical deployment pace. And we believe the flexible mandate should allow them to source a wide range of opportunities across markets. So overall, we believe Oaktree is well equipped to take advantage of an attractive opportunity set. I hope this was a helpful overview, and we are, of course, happy to address any questions you might have.
Jennifer, can we hear from the folks from Oaktree?
Yes, of course. Bob, are you on the line?
Yes, I am. Good morning. This is Bob O'Leary. Am I audible? Could you hear me?
Yes. Loud and clear.
Great. Good morning. Thank you for the opportunity to present to the council this morning. I very much appreciate it. My name is Bob O'Leary. I've been with Oaktree for about 18 years. I joined in January of 2002. I've worked the entirety of that space of time in the opportunities funds, and I've worked exclusively for Bruce Karsh for that, the entirety of that time as well. Bruce, of course, being the Chief Investment Officer at Oaktree and also the original portfolio manager of the Opportunities Funds. I was elevated to co-portfolio manager in 2013. My colleague in that role is Pedro Akiti. We generally divide responsibilities geographically. Pedro handles everything outside of North America, and I handle generally everything inside of North America. We, of course, both report up to Bruce. We have the strategy's been in continuous operation for 32 years, as was noted earlier. It covers over 20 funds. It covers over $40 billion of capital deployed. The strategy's basic insight is true today as it was when they started back in 1988. We aim to buy the debt of companies at the time when it becomes known that they will seek a financial restructuring. We find that there is a great deal of inefficiency around those points in time and the capital structure and the debt securities of these companies at that juncture. The strategy was pioneered back in the late 80s, early 90s. We continue with it today. We have branched out geographically. We now operate in three different major geographic areas, which I alluded to earlier. First and foremost, we have been and focused on the North American market for the better part of those 32 years that the strategy has been in operation. We have a fully scaled platform in Europe that focuses on opportunities there. And we have a growing and nearly fully scaled presence in Asia, which, of course, Pedro manages both of. We are at the present, if we look over the sweep of this strategy's history, there have been to this point 3 major dislocations that have given rise to opportunities for very advantageous capital deployment for our funds. The first, of course, was in 1990-1991 when the strategy was just getting off the ground. The second was in 2001, 2002, right around the time that I joined Oaktree, as a function of many of the restructurings that occurred after the Enron bankruptcy. And of course, the third in 2008 at the time of the financial crisis, which gave rise to a very significant opportunity. We believe at Oaktree that we are at the precipice of the 4th large dislocation in the sort of modern financial history. We think we are uniquely situated to access this opportunity. We have done only distressed debt for the entirety of the life of these funds. In that space of time, again, we've invested over $44 billion. We have generated aggregate profits of $33.5 billion while keeping risk at a very manageable level. You'll note that our losses are low, and of what we count as losses, many of them are unrealized at this point. We are able to invest across multiple geographies and in a variety of different asset classes. We have, I think, expertise in each of these asset classes. We are able to access other parts of the Oaktree credit platform, including but not exclusively our real estate platform, our special situations platform. In total, over the 23 distressed funds since we have started this strategy, we have generated a 22% gross and a 16% net IRR. That goes all the way back to 1988. Generally speaking, our returns are higher on funds that occurred during a major dislocation or times of economic distress. And again, just to reiterate, we feel like we are at the beginning of such an opportunity. We would note also in closing that the opportunity set as defined by the amount of low-rated debt outstanding today is much larger than any other point in history and even larger than what it was prior to the global financial crisis in 2008, roughly 2.5 times as much. With that, I'll pause and ask if there are any questions that I can answer for the council. And again, thank you very much for the opportunity to present.
Thank you, Mr. O'Leary. So now we're going to go to questions from committee members.
Well, this is Lee. I had just one.
Member Austin.
Mr. O'Leary, I just was curious because you had some data with regard to China and India, And my curiosity is, how much of your investment of this fund do you expect to be in China?
Very good question. So we, at this point in time, and it shifts over time, would expect that around in the neighborhood of 15 to 20% of our fund will be in Asia broadly. That's both China and India. We think another 15 to 20% would be in Europe, and the balance would be in North America. If we experience, and we believe that we will, another dislocation on the magnitude of what we saw back in March and April, the percent that we allocate to the United States, to the North American focused opportunities would grow from what I just quoted.
Based on previous losses, what has it been historically in China versus other countries? Has it been disproportionate?
Losses on our investments, on our capital deployed?
Correct.
Yeah, to date, it's been very good. Our underwriting experience has been very good in China. Most investments, most of what we've engaged in China involves non-performing loans, buying pools of non-performing loans, usually on real estate related assets. And to date, the underwriting has held up quite well. I would say as a function of the overall less than what we've experienced in other geographies. Although again, our presence there is newer.
Okay, you don't have to answer this one, but I just think given today's current unrest in the U.S., I hope you're not encouraging Brooke to change his last name.
Brooke, I'm sorry.
Hinchman.
Oh, okay.
Anyway,
let
him keep his name. It's okay.
Okay.
Thanks. That's all I had, Madam Chair.
All right. Thank you.
Further questions?
Madam Chair, this is Nick Tejas here. I just had a question.
Member Tejas?
Yes, I just wanted to ask a question related to senior and subordinate sort of debt, especially in reference to bonds. Do you all have a strategy on just purchasing sort of like investment grade senior types of debt to avoid, to sort of manage risk in relation to, if the viability of the company that we're buying debt on becomes compromised?
I think you've summarized one of the key tenets of our risk control strategy very well. We do focus on instruments that are either secured by liens on hard assets or liens on other assets as well, or are senior in the capital structure by virtue of legal priority and have little to no prior debt or senior debt to them. We are, I think, most apt or most likely to focus on those types of instruments to mitigate losses in the event of adverse developments or performance by the underlying assets. We are also, generally speaking, this was a part of the question, but it was part of the preamble, and we are generally very diversified in our funds. But the answer is yes, we are more disposed or biased towards buying higher in the capital structure, buying instruments that will be repaid first out of the proceeds of the company. And that does help mitigate risk and potential losses in what can be volatile situations at times.
Okay, thank you for that. And if you could just, we probably have public members that are listening in. If you could just explain the difference between like a senior debt sort of structured purchase scenario compared to a subordinate. And I think you hit on it where basically the senior types of bonds and potentially debt would be paid back first prior to other investors.
Is that right? And that is inaccurate. I think you hit on it again. The best, there are many distinctions in, how assets are allocated during a restructuring or even in processes that occur outside of court regarding, but probably the biggest distinction is assets secured by liens on the underlying company or its assets versus debt that is unsecured, meaning it does not benefit from those liens. And secured debt is entitled to be repaid first out of the collateral, the assets that they are secured by in a restructuring process. And that is a form of protection that we find very beneficial and help mitigating losses. There are other forms of seniority that involve legal structuring and legal where debt is situated within a legal entity, but the primary distinction is secured versus unsecured debt.
Great.
Further questions?
Madam Chair, this is Tim. I have two questions, please.
Member Eichenberg, yes.
Thank you, Madam Chair. I think the first one's for Vince. Because of Brookfield's acquisition of Oaktree, we have a substantial investment in Brookfield, and I was just wondering, Vince, do you feel there could be a potential conflict? Would there be management risk here as we go forward with this kind of a break-off?
Mr. Treasurer, we don't see conflict. Is there a risk of the two managements combining, in terms of dollars under management for the total, in the asset classes that we have investments with both of these managers, or this will be the first one with this manager, we're way away from your policy limits.
Okay, do you think there'll be difficulty with a key man? There won't be any key man risk as the acquisition continues?
We don't think so, and Axia's analysts may be able to answer in more detail, but both Brookfield and Oaktree are quite diversified in terms of the management of their various strategies. But if Axia's analyst has a little more detail, he might want to chime in.
Sure. Hi, everyone. This is Aaron from Axia. We would say, as with any external owner, there's always potential risks of conflicts of interest. We have generally been able to get comfortable with this ownership structure, given that the current Oaktree shareholders have an 8 to 10 year sunset for selling their ownership. And more specifically, Howard and Bruce, who are the largest shareholders, can sell up to 12.5% of their interest per year for 8 years starting in 2022. So we think there's a pretty long sunset in place that will certainly keep them engaged during the life of this fund.
Thank you, Aaron. My second question, Madam Chair, is I guess back to Oaktree, and it has to do with your energy concentration. That you're up now to 37% that you've identified. And I was wondering, you make a statement further in the beginning that you're targeting companies that have the best staying power and possess the liquidity to weather the storm, so to speak. And with a concentration of 37%, can you give me some examples of energy companies that you're and how your strategy is working to weather the storm as we see how bad it's, how the ups and downs that we're seeing in energy now?
Very good questions. This is Bob again. We've had a interesting experience in energy. I think you might be referring to our the chart in the back of the deck that shows where we deployed our capital during the months of March and April, although maybe it's from a different source. what we found in energy in that period of time was among the biggest dislocations, among the biggest vacuums of capital support that we've seen or I've seen in my career. And that was caused by three things in my observation. One, a very negative sort of environment for energy assets generally coming into the month of March. Two, a real questions cast upon how much demand there would be for energy in a post-COVID environment. And three, the second, another event that occurred in the month of March, which was a market share war between leading members of OPEC. Those three factors combined made for a very substantial and very, frankly, very interesting buying opportunity for us. We approached it in a way that we typically approach these situations, which is to buy as high in the capital structure as possible, meaning secured or unsecured debt that has no prior debt. In many cases, we were buying investment grade debt, which had very little secured debt in front of it, if any, and buy very debt that is backed by incredibly high quality assets. We also felt to a very significant degree that the environment that existed in March and April could not persist. Could not. The world is to some degree dependent on energy, broadly defined, and if there was any recovery, which we felt confident there would be, in the economic factors that prevailed for that month and a half period of time, that energy demand would have to respond as well. So we were reasonably aggressive in our purchasing, and this is also another feature of our buying, is that when there are moments of tremendous dislocation, tremendous crisis, you will find us deploying more aggressively than I think other strategies. And I will say, as we stand today, much of that energy exposure has rebounded quite significantly, and probably is our best performing asset class over the last 3 or 4 months, and we have subsequently sold off a fair amount of that exposure. So your point is well taken. It's been a very difficult environment for energy related assets for the last 5 years, for the last 7 years, frankly. But I think we had a point of view that we had reached kind of the floor, the lowest possible point, and made investments that backed up that point of view. But your point is it's very well made. When we approach situations like this, we are highly aware of the downside and try to lend or try to buy debt with enough discount to the face value and as senior in the capital structure as we can, while still making the prospective returns that we talk about with our limited partners. And we do diversify quite a bit. Is that responsive to your question?
Yeah, thank you. You have a strong reputation and you have a great track record. So I appreciate your comments there. I'm going to follow up just one more with member Rawson's question about your expansion into China and India.
Yes.
You didn't talk about the geopolitical as much as I hoped. Could you kind of elaborate a little bit more on that and how you're trying to manage that risk, so to speak?
So I will say that, we've been cautious in our growth, in our deployment patterns in Asia as a general matter. It's anytime we go into a new market, I think if you go back again over the 32 years of the strategy's history, what you would find is that we are very, very deliberate in approaching markets we haven't been in before, largely because we want to make sure that creditor rights are protected. And so we were cautious just as a matter of our general philosophy going into China and India. We are very aware of the geopolitical situation, and it is fraught in many ways. I think what we've experienced to date is, to the, not the operations on the ground, if you will, have not been disturbed. We are always mindful that that could change and change very rapidly. Our deployment has slowed over the last year in reflection of better opportunities here in the United States and then to some degree in Europe, and also in some degree in relation to the difficulty in calling the geopolitical environment, to your point. And I think we are very measured. We are more measured right now than we were when we first started investing there. And we will continue to be so. But to date, we haven't experienced any disruption of the existing legacy investments that we have there, other than what you might expect given the pandemic. And so we are, we think this is a market that if you are going to be involved in distressed debt, that you have to have a presence and you have to have a point of view on. But we are mindful of the risks generally and in specific, given, as you say, the geopolitical situation.
Thank you. Thank you for that. And thank you, Madam Chair. That's all I have.
Further questions?
Madam Chair? Madam Chair?
Yes.
This is Tim. Do you all discount, or how do you rate this pandemic thing about people blaming China for all this stuff? I mean, they seem to get a pretty good hit on it. Do you discount? Do you take that in consideration when you look about your investments?
We have focused our investments on areas that, first of all, are removed from some of the more, and this is even prior to this year, focused on areas within China that are less affected. Of course, it's, no country is unaffected. We are, again, the back and forth between China and other countries, China and the United States, has been, we're monitoring it closely to see if it escalates, if it turns into something that's more fraught than it is right now, and it's fairly disjointed. And we have, again, I think, starting probably last fall or maybe even earlier late last summer, we had been tempering, taking down our exposure there, not because we knew what was going to happen, but because we were aware of some of the political risks and wanted to be mindful of that. So we certainly do take it into account and make sure that it's a part of every investment that we make there. It's part of the calculus when we underwrite something. And that applies to India as well.
Yeah, it just seems like the president's making a point an awful lot about some of his comments about with China, and I didn't know if that will echo around and beat around a lot. Okay, thank you.
No problem. Thank you.
All right. Any further questions? I think we're ready for a motion.
Madam Chair, this is Linda Eisen. Based on the recommendations of the Council Investment Committee, Fixed Income Advisor Axia, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $100 million to Oaktree Opportunity Fund 11, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Harold, second.
Okay, we've got a proper motion and a second by Member Eidson and Member Lavender. Any discussion on that motion? I'm going to have Carrie do a roll call vote, please.
Commissioner Garcia Richard?
Yes.
Secretary Romero,
Yes.
Treasurer Uptenberg,
Yes.
Peter Frank,
Yes.
Linda Eisen,
Yes.
Harold Lavender,
Yes.
Lee Rawson,
Yes.
Tim Jennings,
Yes.
Mike Messina,
Yes.
and Nick Hayes.
Yes.
The unanimous decision.
Very good. Okay, we want to thank the folks for being on the line from Oaktree, Mr. O'Leary and your associates. Thank you for being with us to answer questions today. With that, we're going to go to agenda item 4D, the vote on Silver Point. Vince.
Thank you very much.
Yeah, let me pass right to Mahal for the staff introduction and then on the consultant and the manager.
Thank you, Vince. Once again, along with our fixed income consultant, Axia, on the line, we have Edward Muley, the founding partner and the CEO of Silver Point Capital, as well as Eve Tush, partner and head of investor relations at Silver Point. SIC, in consultation with Axia, would like to recommend a $100 million commitment to Silver Point Specialty Credit Fund 2. Silver Point Capital has over 18 years of experience in global credit investing across cycles and currently has about $10.5 billion in assets under management. We do believe that Silver Point is well positioned to take advantage of a significant opportunity set in special situations lending and mispriced secondary opportunities. The rising opportunities can be placed in one of the four buckets. Number one, rescue lending. These are the loans to high-quality companies with an imminent capital needs. Number two, secondary opportunities. Number three, special situation asset-based lending opportunities. These are loans collateralized by hard assets, often real estate. And number four, special situation middle market lending. We would also like to direct your attention to the significantly expanded loan markets that have more than doubled in size since 2010, as well as very big changes in the holder base, specifically the shift away from banks and therefore large voids left in mid-market loans. All these factors combined with forced selling that occurred in the current downturn result in very attractive origination and secondary opportunities. This strategy will be within the lending strategies sub-allocation of the non-core fixed income portfolio. And we at SIC strongly believe that Silver Point's investment platform, as well as its sourcing and underwriting capabilities, along with significant experience managing assets throughout cycles, will allow them to make a material contribution to the lending strategy sub-allocation of our non-core fixed income portfolio. Let me pass it over to Axia for further comments.
Thank you, Michelle. As you already are aware, New Mexico State Investment Council has a relationship with Silver Point through their distress funds. They've been extremely patient with their capital and on the distress side. And, you know, as expected, they've been able to be much more active in recent months, which we're very pleased with. I have Philip Millard here with me to discuss Silver Point Specialty Credit Fund 2.
Sure. This is Philip here. As was previously mentioned, Silver Point is a distressed and specialty lending firm with approximately 160 employees managing $10.5 billion in committed invested capital across its credit platforms today. The founders, Edward Milley and Robert O'Shea, left Goldman Sachs in the early 2000s to start their own hedge fund. At Goldman, they ran a special situations and loan origination business, which they continued at Silver Point as part of the liquid sleeve of their flagship hedge fund. So Silver Point raised its first specialty lending drawdown fund in 2015, which was focused on special situations private originations. And as a follow-up, the firm started raising Specialty Credit Fund 2 last year. The fund originally included a dislocation sleeve that would be utilized in the case of a market downturn, and COVID-19 has opened the door for the deployment of that capital. The fund will utilize leverage of approximately 1x debt to equity, will target a net IRR to investors of 11 to 14%, and features an investment period of 3 years and a harvest period of 2 years. In terms of the opportunity set, As previously mentioned, the fund will target 4 primary areas. The first area is rescue lending, where the fund will look to originate loans with a 20 to 25% target gross IRR to companies with an imminent capital need or undergoing a bankruptcy or restructuring process. The second area of focus is mispriced secondary opportunities, including performing secured bank loans purchased at a discount to par, as well as hung syndications where the fund may be able to increase pricing, tighten documentation, and take an outsized allocation. The team expects an 18 to 20% gross IRR with these types of investments. Thirdly, the fund will also be active in the area of special situations lending, a major focus of Fund 1, with loans with a mid-teens target gross IRR to middle market companies, typically with regards to less competitive and more complex deals than traditional direct lending. Then finally, the hard asset vertical of the fund will target loans collateralized by hard assets, often real estate, which typically requires speed and certainty of execution with a target gross IRR. Overall, we believe there are a number of merits that we highlight in our report with regards to the offering. SilverPoint has the ability to leverage the broader organization, including the trading desk of the hedge fund for sourcing and the industry teams for analysis. We also believe that their restructuring team is fairly strong, has been around since 2008, and has a strong culture and is very active in managing credit. And we also believe that the firm in general, as well as Fund 2, have been patient in deploying capital and in re-entering the market, waiting for an opportunity like COVID-19 to present itself. In terms of risks, high level, we note that the opportunity set could start to recede given the recent Fed intervention and government actions. But overall, we expect rising defaults and downgrades to still produce attractive situations where SB can get involved. And overall, we're positive on the fund, and we believe they're well positioned for the opportunity set in this environment. So happy to open it up to questions and hope that overview was helpful.
I think we can pass it on to Edward Millay, and then maybe take questions at the end.
Okay. Good morning. This is Ed Millay, and thank you all for your time today. I hope that everyone is staying safe and healthy. First, I wanted to say we value our longstanding relationship with the New Mexico State Investment Council. We appreciate your continued support of SilverPoint through your allocation to both the flagship hedge fund and to the distressed opportunity fund. We're pleased to have the opportunity to present to you today and give you an introduction to our special situation direct lending vehicle, Specialty Credit Fund 2. What I'd like to do today is provide you with an overview of our lending strategy, talk about our experience in the space, and how our platform and comparative advantage have positioned us well, particularly in light of the increasingly attractive opportunity set to successfully generate very attractive risk-adjusted returns for our investors. Bob and I founded SilverPoint in 2002, and the strategy remains the same since inception: to build a global credit platform with a focus on areas of the credit markets with complexity and barriers to entry. These areas of the market require deep fundamental credit analysis and an ability to be active, which drives attractive risk-adjusted returns across cycles. Today, the SilverPoint platform is comprised of the flagship hedge funds, our distressed opportunity funds, and our specialty credit funds. The Specialty Credit Fund is a par origination strategy targeting special situations direct lending opportunities to middle market companies. When Bob and I were running credit and special situations businesses together at Goldman Sachs in the mid-1990s, we saw that if you had the ability to source, analyze, underwrite, structure, and manage loans, you could be a provider of capital to companies where there was reduced competition, and therefore charge a premium compared with traditional sources of financing, and also to structure the loans with enhanced downside protection. We leveraged our expertise in understanding companies and industries and our ability to do a private equity style analysis on what a company is worth, and married with a deep understanding of structuring, documentation, and how to protect against the downside. When we founded SilverPoint, we built the same business for SilverPoint. Since 2003, we've invested almost $11 billion in the lending strategy across 230 loans. In 2015, we launched a dedicated vehicle for this special situations direct lending strategy called Specialty Credit Fund 1. To date, the fund has performed very well, generating attractive risk-adjusted returns to investors, and the portfolio is comprised of over 90% first lien loans. We're raising Specialty Credit Fund 2 as we seek to continue to build upon the success of Fund 1 and believe the current market environment has led to an increasingly attractive opportunity set. We believe the specialty credit strategy is extremely synergistic to our other products, and being part of the $10.5 billion global credit platform of Silver Point provides the lending business with many advantages. You have to do many things well to be successful at par origination lending across cycles. You have to have differentiated sourcing. Secondly, an ability to underwrite the credits and do top-notch credit analysis. 3, you need to structure and have structuring and documentation expertise. And finally, you need to be expert at monitoring and asset management. Specialty Credit Fund 2 leverages our core credit expertise and critical components of our platform. We have a deep understanding of and experience investing in global credit markets throughout cycles. We also have experience and expertise in this strategy, having managed par origination businesses since the mid-1990s. We have a deep team of over 160 people with approximately 60 investment professionals at the firm. Our network of relationships, including advisors, brokers and broker-dealers, attorneys, and so forth, to whom we are a well-respected partner, provide us with differentiated sources of financing opportunities. And finally, our team has a deep understanding of industries and company valuations, structuring and documentation, and asset management. We believe our deep fundamental credit skills position us to be able to understand companies and capital structures across industries and make us a creative and thoughtful partner to borrowers. We understand how to structure loans with significant downside protection in order to mitigate losses for our investors, as well as to ensure we are properly compensated for being a liquidity provider when public and private markets are disjointed or closed. Our ability to manage loans and work with companies through periods of growth and stress protects our investors and our investments. Special situations lending persists throughout credit cycles if you have properly structured your business. Today, in light of the current market environment, we feel that we're even more uniquely positioned to take advantage of the opportunity. While there has been an abundance of capital raised in the private lending space chasing return, our views prior to the downturn were that we were late cycle and entering an environment where there would be less capital available in public and private markets. The environment enhances the direct lending investment opportunity, and you have already started to see this play out. In the publicly traded markets, collateralized loan obligations, or CLOs, and retail investors such as ETFs and mutual funds have become the primary player and buyer and tend to be very sentiment driven. You've seen activity, particularly on the CLO front, shut down, which ultimately creates a vacuum of capital for middle market companies. In the private markets, many credit funds have not managed a portfolio through a recession and have been chasing opportunities in yield. These funds do not have core credit expertise or workout experience, and therefore we believe that they will be more focused on managing their portfolios, taking their eye away from originating good new loans. We believe that this is exactly the time when you want to have dry powder and be a provider of capital. Silver Point knows how to work with companies across industries to provide them with financial solutions. Our platform enables us to be in active dialogue with the advisory community, specialty brokers, dealers, consultants, and so forth. They are actively looking to help their clients find customized capital solutions, and we have worked and partnered with them over many credit cycles. As we think about Specialty Credit Fund 2 today, we're even more excited about the potential for the fund as competition has been reduced and the opportunity set has increased. Thank you again for your time today, and we're happy to answer any questions you may have.
Thank you, Mr. Moulay. So I'm going to go now to committee for questions. All right, do I have a motion for the Silver Point investment?
Madam Chair, this is Linda Eidson. Based on the recommendations of the Council Investment Committee, Fixed Income Advisor Axia, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $100 million to Silver Point Specialty Credit Fund 2, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
It's Harold, second.
All right, we've got a motion from Member Eidson, a second from Member Lavender. Any discussion on that motion? We're going to have Carrie take a roll call vote, please.
Commissioner Garcia Richmond?
Okay.
Yes.
We'll see you.
Secretary Romero?
Yes. Oh,
Treasurer Eichenberg?
yes.
Peter Frank?
Yes.
Linda Eidson?
Yes.
Harold Lavender?
Yes.
Lee Rothman?
Yes.
Tim Jennings?
Yes.
Mike Messina?
Yes.
And Nick Tayes?
Yes.
Thank you. It's a unanimous decision.
Okay, thank you very much for our presenters. Thank you to the folks from Silver Point, Mr. Moulet, and your associates for being here with us today to present. Next, we're going to go to agenda item 4E, the vote on an investment into private equity with Menlo Ventures 15. David?
Thank you, Madam Chair. This is David Lee. Good morning. I'm the private equity director. I'm joined on the call by Chris Cassidy, also Richard Pugmire and Amy Ridge from Mercer, and then Venki Gunnison from Menlo Ventures. For reference, these materials start on page 362 of diligence, and Venki will be going through a presentation that starts on 426. Just wanted to provide some quick summary comments and turn it over to Mercer for some further comments, and then we'll launch into the presentation. Menlo Ventures 15, this fund strategy will focus on both early stage and seed stage venture capital investments. The seed stage will be invested primarily through Menlo Labs, which is an in-house incubator to seed and form new technology companies. The seed investments will be in the $1 to $2 million range for up to 30% ownership. And this strategy will be predominantly investing in North American-based companies. This would be our first commitment to venture capital in the national program for several years. The current target is 0 to 5% for venture capital, and the most recent active venture capital fund in the national program is a 2007 vintage. The investment focus for this fund will be in consumer, enterprise, and life sciences, and specifically digital workflows, vertical software as a service, mobility, cybersecurity, financial technology, marketplaces, artificial intelligence, cloud infrastructure, robotics, healthcare data, and life sciences. Menlo 15 has a target of 30 to 35 companies in the fund, and the target size for 15 will be $500 million, which is slightly larger than Fund 14's $455 million in commitments. The general partner commitment here is roughly 3%. For the early stage investments, the initial check size would be 5 to 10 million, with obviously some follow-on investing, and they're seeking a 10 to 25% ownership. Historically, Menlo Ventures has been one of the premier venture capital firms and therefore difficult to access. Performance for the last 4 funds, 10, 11, 12, and 14, because they skipped Fund 13, has been strong, with 3 of the 4 funds ranking in the first quartile in the Burgess North American Venture Capital universe, and all 4 ranking in the top quartile for distributions to paid-in capital. Menlo has a 35-person team, including 13 investment professionals and 4 employees in the portfolio services team, which is called Menlo Fuel. And they have their main office in Menlo Park, California, with a satellite office in San Francisco. So staff and consultant are recommending a commitment of up to $30 million in Menlo Ventures 15. And this would be the first commitment to Menlo Ventures. With that, I will turn it over to Mercer for additional comments.
Thanks, David. This is Richard Pugmire from Mercer. I thought I would spend a little bit of time just answering some potential questions that you may have. One of them is, why hasn't there been a venture capital fund in the national program? We've always looked at venture capital funds and came close with a few over the years, but there's really 2 reasons why you haven't seen a venture capital recommendation from the national program in recent years. One is access and sizing. We want top-tier managers in the national program, and access is difficult because most have smaller fund sizes than you see in buyout. So if we can get access, sizing is always an issue, as they usually offer a significantly smaller size than what we're looking for. The second reason is we've always been cognizant of the venture capital exposure in the New Mexico program, so we don't want to inadvertently double down on venture exposure by having a large allocation in the national program. So we sized this commitment at $30 million after all those considerations and discussing with Menlo Ventures what they're able to give the SIC. Also, there are ancillary benefits with this commitment. We've known Mercer for a long time, and we've actually used them to introduce New Mexico companies over the last year, and they've always been open to introductions. Also, during the due diligence process, the Menlo team talked about establishing relationships with New Mexico managers and sharing deal flow to help with the economic development mission of the New Mexico program. So even though this is a national program commitment, there are some ancillary benefits that we hope will benefit the New Mexico program as well. One of the other areas you may have noticed is the fund terms. We look at a lot of buyout funds in the national program, and venture capital funds generally have higher terms than buyout funds. Menlo's management fee is at the high end of what we see, but it's not different from other top-tier venture capital firms. And it's also important to note that the carried interest percentage is actually lower than it is at other top-tier venture capital firms. So if you have to choose, we'd rather have that lower carried interest, and any capital collected for the management fee is repaid as part of the distribution waterfall, assuming that they generate good performance. We have looked at other venture capital funds that start at a higher carried interest, and that's where you really get a drag on performance. In addition to the pros discussed in our report and that David highlighted on, it's good to know that Menlo has been transparent through their reporting and discussions in the due diligence process, which we think is important for a venture capital fund. We think this is actually a great addition to the national program. And with that, I will turn the time over to Venki from Menlo Ventures for a short presentation.
Thank you, David. Thank you, Richard. We appreciate the opportunity. We know it's a privilege to manage the public asset, and we don't take that privilege lightly. I will be going through the presentation, and I want to thank you again for the opportunity. We'll start with the slide Menlo by the numbers. Just to set
Would you
some
introduce
context.
yourself, sir? Would you
I'm sorry,
introduce yourself?
This is Venki Ganesan. I'm a managing partner at Menlo Ventures.
Thank you, Mr. Kneesen.
Just a little high-level overview on Menlo. We are a 44-year-old firm. We were started in 1976, and over the last 44 years, we have had consistent performance. We have had 70-plus portfolio companies go public, 150-plus M&A, and we have distributed over $8 billion to our LPs. All the numbers you will see in my presentation are net. We look at that seriously, and most people would consider us to be one of the top firms in Silicon Valley, definitely one of the historic firms. Our track record is on the next page, and that gives you a sense of how we have managed through multiple up and down cycles. One of the things we think is very important in venture capital is to have experience both in an up cycle and a down cycle. So over our 44 years, we have seen both recessions in the 70s and 80s. We have seen the technology boom in the late 90s, the dot-com collapse, the 2008 financial crisis, and now the 2020 pandemic. We believe strongly that throughout these crises that investing in technology that have high growth opportunities creates incredible returns for all investors. And if you see our most recent fund, the 2017 Menlo 14 fund, is at a very fast pace, so the 30% IRR already, and has had high DPI relative to its peer funds. The next slide is around notable exits, and it gives you a sense of the kind of liquidity we have had. Now, if you spend time on venture capital, you will see a lot of very highly valued companies. And a lot of them are private valuations, and we have those too. But we have also been very lucky to have had a lot of exits recently, and I will go through some of them. But over the last 25 months, we've returned over $3.5 billion to our limited partners. We think that's an essential part of the Menlo strategy, is to make sure that we can provide consistent liquidity to our venture partners. One example of that is our case study on Uber. So if you look at the case study on Uber, we invested in the company in 2011. Our initial check was around $20 million. We ended up owning roughly 10% of the company for $20 million. And then over time, we invested a few more dollars, totaling $67 million. And then as the company grew and escalated, we sold a portion of
We would just like folks
our...
to, Mr. Ganesan, if you could just pause for 1 second. Can folks please mute their phones? Thank you. You can continue, sir.
Thank you. And so over the course of the last few years, we have started selling our Uber stake, and we sold half of it to SoftBank in 2018, and then managed the distributions. And in fact, we distributed most of our Uber proceeds before the pandemic, not that we knew it was going to happen, but we were just trying to manage that for our limited partners. And in aggregate, we realized over $2.3 billion in return, which is a 35x, and over a gross return of over 119% IRR. Now, I wish every company we invested looked like Uber. They don't. We also have things that haven't worked out. But in aggregate, we feel very fortunate to have backed some really iconic companies. The next slide really talks about our consistent liquidity. We talk about this because, again, a lot of venture capital today has a value in the private markets, but not in liquidity. So they have not been able to convert their high valuations into cash or stock. We have been able to do that consistently from 2000. And so I particularly point out to years like 2001, 2002, where you had the dot-com collapse, or 2008, 2009. The reason why that's important is that because we have backed high-quality companies and have been doing this for a while, we've been able to manage through those cycles much better than some of our peers. I will end with the last slide, which is punching above weight. One way to look at how Menlo Ventures compares to the rest of its peers is to think about how much money do we manage and what percentage of the distributions we are. So this slide basically says the total distributions for all venture capital and what is Menlo's contribution. Now, it's important to know that we manage, in terms of total capital managed, we are less than 0.5% of the venture industry. And between 2000 to 2018, while the venture capital industry as a whole returned $340 billion, we returned $5.7 billion. And between 2014 to 18, when the venture capital industry returned $128 billion, we returned $2.5 billion, which is 2%. And in 2018, while the venture capital industry returned $27 billion, we returned $1.6 billion. So that's 5.6%. Compare that to the fact that we only manage 0.5% of capital. We are somewhere between 3 to 6x better than our peer group. And I think that one stat tells you a sense of who we are. A few other things before I finish. I had the opportunity to be the chairman of the National Venture Capital Association a couple of years ago. And on that role, I tried really hard to figure out how to get venture capital to spread, not just from the coast, but to other parts of the country, including the Midwest and New Mexico. In fact, in my previous firm, looked at one of the companies in New Mexico called Advent Solar. There have only been 7 companies that have raised over $50 million in venture capital in New Mexico. Advent is one of them, and we funded them. So part of our interest level in this is that we have had a long relationship with Washington State, that's been our anchor tenant since 1982. And we spend a lot of time with them being a steward of their assets, but also looking at companies in Washington. And if we have the opportunity to partner with New Mexico, we would do the same by making sure that we look at opportunities in New Mexico and figure out ways we can mentor and cultivate the venture capital industry in New Mexico. I will stop now and take questions.
Thank you, Mr. Ganesan. We're going to go to questions from committee. So I've got a question. Yeah.
No, go ahead, Madam Chair.
So I just actually, in the private equity space, I think very oftentimes there are investments into funds and companies that you know might be. Maybe the investors themselves don't necessarily agree with those particular investments because they are, you know, in profiteering from things that the investors may not agree with. I'm wondering what kind of sort of due diligence does Menlo do, and this is for you, Mr. Ganesan, on just sort of the equity of your investments, the quality of your investments in terms of ensuring that they are sort of above board and into companies that are stellar.
Yeah, I think that's a great question, and Madam, we take that responsibility very seriously. It's not just important for us that we could have good financial investments, but we also need to make sure that committed that our investments, you know, have a social good element to it. That's not the driver, but it's very important that they embody the highest standards of ethics and behavior. Now, I'll give you an example. When as successful as an investment Uber was, the founder of the company, Travis Kalanick, at times showed behaviors not consistent with Menlo's values. And Menlo played a very critical role, my partner Sean, in leading the initiative, which was cataloged in the New York Times, to remove Travis from the CEO position. While we are grateful for his contribution and his impact financially, we still think it's very important that every investment that Menlo makes embodies the highest standards of professionalism. And we are willing to step in and make changes to leadership to reflect that. We hold those same values internally in everything we do. It's not just important for us to win, it's important to win right and make sure that everything we do stands to that quality. And we make sure our portfolio companies live up to that too. And so there have been times when we have changed leadership, there have been times when we have sold our stake, when the companies have not exhibited the values we believe in. And, you know, we realize when you take the public's money, you have a fiduciary duty to live up to those highest standards, and we try our level best to do so.
I appreciate that response. I think I heard a question from Member Eichenberg.
Thank you, Madam Chair. I'm kind of focusing more on Mercer's concerns, but I guess the first question I have, because of Menlo Park in California, are you seeing people moving from California, or do you still think that the market is going to be that strong in the California area?
So we are seeing some people thinking about moving from a high tax state to a low tax state. But first of all, Menlo Ventures invests all over America, so it's not just in California. We do have a bunch of investments in California, but we invest all over. And we think there are going to be opportunities all over. I still think that in spite of some people's movement, the California and the Bay Area will continue to remain a preeminent area for technology disruption. And in fact, I would tell you that post the pandemic actually is going to accelerate digital transformation, and we are seeing that already. When certain sectors, you know, if you were to just look at the stock market, the certain tech sectors, the digitizing areas like real estate and auto buying have continued to outperform. And so we believe that this broad trend of digitization will continue and that California will remain a big, but not the only area of driver of that.
Okay, I noticed that your focus was going to be in health sciences. However, it's not your area of expertise. Have you brought somebody on board or have you just shifted focus?
Yes. So historically, for the first, I think, 25 years, Menlo Ventures had invested in life sciences. In fact, one of the largest biotech companies in the world, Gilead Sciences, was incubated at Menlo Ventures. We are proud that Gilead not only found the cure for HIV and hepatitis, but it's actually the only FDA-approved cure for COVID. It's a drug called remdesivir. And we incubated the company in our offices and owned 80%. Company's worth today over $100 billion. Now, we decided in 2017 to start looking at life sciences again. We had stopped doing life sciences investment in 1997 because of regulatory and FDA issues. But we decided in 2017 to get back into it. And we hired a partner, Greg Yap, who I have known for 20 years, who was an entrepreneur, worked at Genentech, started 2 healthcare companies. And he is helping us lead our life sciences practice. And in fact, we had an IPO 2 weeks ago of one of the first investments he did, a company called Pliant Therapeutics. And so in spite of the pandemic, we've been able to have IPOs and acquisitions in our portfolio.
One of the other things that Mercer pointed out was your Menlo Labs, which is going to be a new startup for you. Can you tell me a little bit more about Menlo Labs and what your vision is there?
Absolutely. So Menlo Labs is an extension of our seed strategy. We have been investing in the seed stage, pretty much all of Menlo, but in the last few years, we've been doing the structure called the Talent Fund. But what we realized is our most successful seed investments were ones in which we not just invest our dollars, but also spend a lot of time and energy building the company. So in many ways, we incubate the company. And our partner, Sean, who's had an incredible track record in consumer investing, he's the lead investor in Uber, Roku, and Chime, was very passionate about thinking about certain areas where today we don't find companies and creating companies. So we've recruited a partner from Groupon named Greg Rudin, and together we are creating a studio in San Francisco to essentially create 2 to 3 companies a year. And that'll be our seed strategy. We're calling that Menlo Labs. And we expect that over the course of Menlo 15, we'll have almost 10 companies created in certain areas. And hopefully they will turn out to be successful.
Madam Chair, my last question is, it gets into the fee structure, because that certainly was a red flag to me. But could you talk a little bit about your historic track record? Because what I see it's driven by is just your 2011 fund and the success you had there. So can you kind of expand on some of the other, so I have a better understanding of where you're going?
Yeah, I would be happy to. And so I would say that when you look at our fee structure, you should know that we recycle 100 to 105% of our investments. The reason that's important is that it minimizes gross net spread. Most of our peer venture firms will only invest, so if you commit $100 to the fund, they would only invest $80, and the rest will go in fees. What we have done in Menlo 11 onwards is that we commit to investing $100 if you commit $100, which effectively means that all the fees get reinvested into the fund. And we've done that in Menlo 11 and Menlo 12. And this is a way in which it minimizes the gross net spread. And we take a risk on the fees because to invest 100% means you're putting some of our fees at risk, but we are comfortable doing it because of our track record. Now, we have had, Menlo 11 has turned out to be a really successful fund, but Menlo 14, which is raised in 2017, $455 million, is shaping to be a very successful fund. We already had 5 exits. It's very unusual in venture capital to have exits. Normally, the way venture capital works is that you encounter a J curve, and most of the funds are negative the first 5 years, and only in year 6 or 7 do you start seeing exits. What's been unusual about Menlo 14 is that our first investment, Jump, was bought by Uber. Our second investment, Six River, was bought by Shopify. We just, our third investment, Indio, was sold. Pliant has gone public, and we just have sold a company to Apple. So it gives you a sense of the kind of traction you've had, and it's I think it embodies our strategy of investing, and I think 14 is going to shape out to be as good, if not a better fund than 11.
Thank you very much. Thank you, Madam Chair.
Further questions? And I believe we're ready for a motion.
Madam Chair, this is Linda Eidson. Based on the recommendations of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $30 million to Menlo Ventures 15 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Harold. I'll second that. As you can tell, I like fast seconds.
Member Jennings?
Anyway.
Tim,
Yes.
can you mute
I'm
yourself,
sorry.
please?
I'm sorry.
All right, we've got a proper motion from Member Eidson and a second from Member Lavender. Any discussion on that motion? If we could go to a roll call vote by Carrie, please.
Commissioner Garcia Richards,
Yes.
Secretary Romero,
Yes.
Treasurer Eichenberg,
No.
Peter Frank,
Yes.
Linda Eidson,
Yes.
Harold Lavender,
Yes.
Lee Rawson,
No.
Tim Jennings,
No.
Mike Messina,
Yes.
and Nick Hayes.
Yes.
The vote passes 7-2.
I actually think it might have been 5-3.
I'm sorry. It's actually 7-6. We have 10 council members voting.
7-3, okay.
7-3, okay. Thank you. And we thank Mr. Ganesan from Menlo for joining us to answer our question. Next, we'll go to our next private equity investment, Bridgepoint. And I'm going to turn it over to David.
Thank you again, Madam Chair. This is David. The staff memo starts on diligence page 44, and the presentation that they're going through starts on diligence page 504. Bridgepoint Development Capital 4, or BDC 4, this fund strategy will focus on lower middle market land investments. The fund will target businesses with enterprise values between $35 million and $200 million, or $30 million and £150 million pounds sterling. The opportunity set is in the UK, France, and Nordic. It is about 35,000 medium-sized companies with annual revenue between 30 million and 150 million pounds sterling. The geographical target is 50% United Kingdom, 25% Nordic, which is mainly Sweden, and 25%. This fund will pursue investments in 6 sectors: business services, technology.
I'm sorry,
and media.
David. Could we just remind folks to mute their phones one more time? It's very hard to hear you, David.
Thank you. Consumer, healthcare, financial services, and manufacturing and industrials. BDC 4 will target 15 to 20 companies in the fund, and the target size is £1 billion pounds sterling, or about $1.25 billion, with a hard cap of £1.5 billion pounds sterling. Fund 3 was 605 million pounds sterling, and funds 1 and 2 were about 300 million. The GP commitment here will be at least 20 million pounds, and the check size range will be between 20 million and 100 million pounds. BDC funds have been oversubscribed, and our previous commitments to Bridgepoint Europe, which is their largest, in securing a potential commitment to the BDC funds. Overall performance for the BDC funds has been very strong, with a 25% gross IRR and a 2.3 times gross multiple, which is about a 20% net IRR and a 1.9 times net multiple. All three previous funds are ranked in the top quartile in the Burgess European buyout universe. BDC is led by 10 long-tenured and experienced partners, and there's a total of 28 professionals located in 3 offices, London, Paris, and Stockholm. Staff and consultant are recommending a commitment of up to $40 million in pound sterling equivalent in Bridgepoint Development Capital 4, and this would be our 5th commitment to Bridgepoint, but the first to the BDC fund series. And before I turn it over to Richard, I neglected to mention that we are joined by William Jackson, Managing Partner of Bridgepoint, Mike Black, Managing Partner of BDC, and John Barber, a Senior Partner at Bridgepoint. And with that, let me turn that over to Richard.
Thanks, David. Bridgepoint is a long relationship for the SIC going back 15 years. This is a capacity constrained fund, and that's why you see the smaller commitment size. We wanted to get access to the strong performing fund series of an existing manager with this commitment, and we hope to grow that commitment over time. In the past, we have avoided bringing funds with less than a $50 million commitment, but when you look at this fund series, if we had done a smaller commitment to this fund in the past, we may be approving a $50 million commitment today as we grew with them. As a reminder, our main desire to size commitments larger goes back to our desire to manage the manager relationships in the portfolio. And I think we've done that well going back to 2011 as we've only made commitments to 25 managers. Two things that I think may stand out in the report that I wanted to address up front, as David did a great job explaining the pros of this investment. One is the terms. The management fee is higher for this series, but when you look at the fund size of this series, it's also smaller compared to the main Bridgepoint fund, which the last fund was $6.8 billion. So on a dollar basis, it's actually a less management fee coming in, even though the percentage is higher. Also, Bridgepoint has had a reduction negotiated if they reach their cap. So the management fee could actually step down depending on how much capital they raise. And the other terms are attractive to limited partners, particularly the all contributions plus an 8% preferred return first. So that means they pay back any capital that you pay for management fees plus an 8% return before collecting carried interest. The other item that may have stood out to you is the fund size increase, which is a common concern highlighted in our reports. We want to bring high performing funds, and these often have high demand, so you often see fund sizes increase. The last fund was pound sterling 605 million, and this one could potentially get to 1.5 billion. When you look at the expected strategy, it's not expected to change much, with the target enterprise value increasing slightly and Bridgepoint using the additional capital to add more deals. So that it actually increases diversification in the fund, so we're comfortable with that. And then, with the positives on this fund being pretty compelling as summarized in our report, we think this is a good addition to the national program and a good addition with an existing manager in the national program. With that, I'll turn the time over to Bridgepoint for a short presentation.
Well, thank you for that. Good morning, Madam Chair and committee members from London. Just starting on page 2 of the electronic presentation you've got, I'm William Jackson.
Sorry, sir, could you introduce yourself? Is this Mr. Jackson?
Yeah, I'm William Jackson, the managing partner of Bridgepoint. And as you'll see on that page, I'm joined this morning by Mike Black, the BDC's managing partner, and John Barber, the senior partner in our Investor Services group. Just turning to page 4 of the presentation, we're delighted to be with you this morning. We've enjoyed and greatly appreciated a 15-year relationship with the New Mexico State Investment Council, successfully partnering over that period in our flagship funds. And today, we're pleased to introduce our highly successful and top-performing lower mid-market growth fund, Bridgepoint Development Capital, which my friend and colleague Mike Black is now going to speak to. Mike.
Thanks, William. Good morning, all. So I'm delighted to have the opportunity to introduce BDC to you all. As David said, we operate in a large and highly dynamic marketplace in Europe with 35,000 companies where our branding, team, and clear points of difference have enabled us to build a strong and consistent top quartile performance over the last 3 funds. Turning to page 6, we look here at the performance in a little more depth. BDC targets 2.5 times plus gross returns by fund, and we are developing a strong track record with both funds 1 and 2 above this target in December 19, and all funds showing encouraging gross and net IRRs. On page 7, BDC is focused on structurally supported growth businesses operating across Europe, where typically the end market is growing between 5 and 15% per annum. And just to reinforce, we're looking at transactions which are in the main between £30 million of enterprise value and £150 million or $200 million. We're doing that with we're addressing our space with a top-rated investment team, and importantly, leveraging Bridgepoint's strong and highly differentiated platform with its global network of offices, with the US and China being prized capabilities, our sector insight. And in addition, it's worth reinforcing that the investment team are focused almost entirely on the investment business, and we are able to leverage Bridgepoint's outstanding support platform to enable us to focus on investment. So on page 8, I touched on the importance of structural growth to our proposition, and this key investment theme is often underpinned by technology. And a BDC investment will typically benefit from a number of these growth drivers, including being market leaders or capable of leading, and offering internationalization, buy and build, and operational improvement as growth relays for further development. On page 9, we have a highly active value creation approach, driving sales growth, professionalizing management, and building functional capabilities and expertise. We're regularly involved in upgrading tech platforms in our investee companies and executing value accretive M&A. And these efforts, when taken together, drive encouraging portfolio performance. We've shown consistent 20% revenue and EBITDA growth over the last decade against a relatively lackluster macro. On page 10, we talk about BDC's approach to origination, and we benefit here from a very high volume of opportunity. And our challenge is to focus and filter whilst maintaining our investment discipline. And we do that by applying our sector lens, our digital thematics, and leveraging Bridgepoint's brand and access and insight to gain access to premium opportunities. And we see a very significant opportunity for thematically led, disciplined investment to deliver premium opportunities to the funds. On page 11, we talk a little about the team. We've got a deeply experienced and highly capable team of 28, 10 partners, 9 on the investment side, and having entered BDC 3 with only 5, and with an average of 18 years of private equity experience. But behind that, we've got a very strong maturation of skills within the team and a highly talented director and investment director tier supporting the partners. Importantly, in the main, we grow our talent from the bottom up, and you can see on page 11 3 pictures of Mansui, Vicky, and Therese, who are our most recent joiners. Bridgepoint has a well-established ESG policy and framework, and you can see that on page 12. we expect our portfolio companies, amongst other things, to create new employment, reduce their environmental impact, and ensure that they're paying fairly and focusing on staff welfare. The two examples show a strong focus around sustainability, reducing carbon footprints, whilst driving growth and new employment. So just to conclude on our team, BDC is targeting structurally supported growth assets in the European lower middle market. We're doing this with our first-class team of professionals, leveraging a highly differentiated platform and outstanding deal flow in our marketplace. And these factors are driving consistent top quartile performance. Thank you.
Thank you, Mr. Black. And I will begin just by asking my own question before I go to the rest of committee. Similar to what I had asked of the Menlo folks, just in the private equity space, and you talked a little bit about your ESG companies, but I'm wondering kind of what steps you take if it, one of your portfolio companies, it turns out is not aligned with your values as an investment company. What kind of steps do you take in that case?
Well, we have a very rigorous ESG policies applied right across the firm, and it forms a key part of our pre-acquisition diligence. I think that's probably the most important point to note. And if we were to identify a red flag topic, then obviously we wouldn't pursue an investment. But quite often we identify housekeeping topics, which often relate to refreshing or upgrading companies, anti-bribery and corruption policies, or things which go to processes that need to be tightened up as businesses professionalize. Those sorts of things just form part of what we would describe as our 100-day plan, and we would enact post-acquisition. But we wouldn't buy a company that we thought had major challenges. And to the extent one were to arise, we'd look to treat with it, promptly and thoughtfully.
Okay, I'm going to open it up to questions from committee.
Madam Chair, this is Tim. Can I just make a comment?
Yeah.
Thank you, Madam Chair. I just wanted to thank you for actually putting in a section of ESG. I thought it was kind of refreshing. I think that if you look at the national kind of trend, so to speak, is ESG does, and people that invest using ESG are doing fairly well in comparison to others. So, and in some cases even better. So I wanted to just say thank you. Thanks all, Madam Chair.
Further questions from committee? Do we have a motion?
Madam Chair, this is Linda Eidson. Based on the recommendations of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of a pound sterling equivalent of $40 million to Bridgepoint Development Capital 4 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Harold, second.
Okay, we've got a proper motion from Member Eidson and a second from Member Lavender. Any further discussion on the motion? And with that, we're going to take a roll call vote from Carrie, please.
Commissioner Garcia-Richard?
Yes.
Secretary? Let me get some more information. Secretary Romero?
Yes.
Treasurer Eichenberg?
Yes.
Peter Frank? Linda Eidson?
Yes.
Harold Lavender?
Yes.
Steve Rawson?
Yes.
Tim Jennings?
Yes.
Mike Smith?
Yes.
Nick Hayes?
Yes.
And Peter, I didn't hear your vote. Can I go back to you? Maybe we've lost Peter. But the vote does pass unanimously.
Okay, thank you very much.
I'm here. I'm here. Can you hear me?
Yes, now we,
Yes.
yes, yes. Thank you, Peter.
And what is your vote, Peter?
I did vote yes. Can you hear that?
Very good.
Yes.
Thank you so much. Thank you so much. We couldn't hear that at first. All right, so with that, we want to thank Mr. Jackson and Mr. Black and their colleagues for being with us today and to answer our questions. We'll move on to agenda item 4G, the New Mexico Private Equity Policy and Procedures. And I guess, Chris, you're going to present this one?
Yes, thank you, Madam Chair. This is Chris Cassidy. I work with Dave on the private equity portfolio. As a reminder, last November, we brought a structure study for the New Mexico program, which recommended a number of changes to the program, including regarding the policy. So the document in front of you is a revised policy to reflect some of those changes which were recommended in the structure study. I'll highlight a number of the major changes. First of all, the cap for the program was increased to 11%. That was done via statute. And then as part of that, we increased the target allocation for the program to 9%. We made a distinction between fund commitments and emerging manager commitments. This was to incorporate the potential for some other local managers to participate in the program. Given the COVID pandemic, we added the New Mexico Recovery Fund as part of the program to make that clear that that $100 million commitment is part of this program. And then there was a number of other kind of cleanup items where we felt the document had a little too much language for things that probably weren't super relevant to this program, such as the sale of limited partner interests, which are not a very likely event for a program of this nature. In addition, at the CIC, members Eitzen and Lavender recommended a number of additional changes to the document. Member Lavender recommended that we just make sure that the differential rate nature of the program, which is in the underlying statute, is part of the policy. And then Member Eitzen had a number of comments, or the most material being she asked us to add background checks as part of the due diligence process in the emerging manager program. So from there, I'll open it up to questions if there are any.
Thank you, Chris. Questions from committee? Okay. Seeing none. Do we have a motion?
Madam Chair, Linda Eitzen. Based on the recommendations of the Council Investment Committee, New Mexico Private Equity Advisor Mercer, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve the New Mexico Private Equity Policy and Procedures as memorialized and discussed by the Council at today's meeting.
Second, Harold.
Okay, we've got a motion from Member Eitzen and a second from Member Lavender. Any discussion on the motion? We're going to have Carrie take a roll call vote again. Thank you.
Commissioner Garcia-Richards?
Yes.
Secretary Romero?
Yes.
Treasurer Eichenberg?
Yes.
Peter Frank?
Yes.
Linda Eitzen?
Yes.
Harold Lavender?
Yes.
Lee Rawson?
Yes.
Tim Jennings?
Yes.
Mike Messina?
Yes.
Nick Hayes?
Yes.
Do you have a unanimous decision?
Okay, great. So thank you to our staff for the work on updating our New Mexico private equity policy. And next we're going to item 4H. We'll hear from Starla on the domestic equity structure study.
Hi, this is Starla Bennett, and Clayton Cleek, Matt Sturdivant, and I will review the U.S. public equity structure study. But before I get into the details of the study, I want to give you the bottom line up front. Since this portfolio was reconstructed in 2012, the portfolio has not met either goal of outperforming the Russell 3000 index or ranking median or above in the Tux peer universe. And so this structure study recommends the most significant changes since 2012, which will include, number one, moving from a defensive portfolio to a portfolio similar to the Russell 3000 index in terms of risk and exposures. Two, to allocate 68% to the Russell 1000 market cap index and 32% to 4 current high conviction managers. And then number 3, to terminate 4 current managers, 2 active and 2 factor based. The estimated fees will be about half of the current fees. This is approximately 8 basis points. And I'm going to spend about 10 minutes and touch on 15 slides. So with that, let's skip the executive summary and turn to slide 6, which is Diligent 580. The purpose of the portfolio is threefold. One, to generate significant returns with a current long-term return assumption of 6.8%, to provide liquidity, and to provide exposure to economic growth in the U.S. Turn to slide 9, Diligent 583, excuse me. So here are the numbers. Goal number 1 was not met. Net excess returns were negative for all time periods. And goal number 2, the portfolio ranked in the 3rd quartile rather than above median for the 3, 5, and 7-year periods. So please turn to slide 11, Diligent 585. The strategy since 2012 has been defensive, a lower risk portfolio than the Russell 3000 index. And historically, a defensive strategy has generated the same returns as the Russell 3000 index when the market was going up and outperformed the index when the market was going down. This has not been the case in this most recent market cycle, and therefore the recommended portfolio strategy is a style neutral portfolio with a higher allocation to the market cap index and less tracking risk. Please turn to slide 15, Diligent 589. Slide 15 shows the evolution of the portfolio. I'll make 3 points. One, from 2011 to 2019, the allocation to U.S. public equity as a percentage of the total fund decreased from 45% to 20%. Number 2, in 2013, 100% of the assets were transitioned to external managers. And 3, in 2014 and 2017, factor-based strategies were added to the portfolio. So slide 17, Diligent 591. The Russell 3000 index is a hard benchmark to beat. And this chart shows that in the Tux peer universe, the index's percentile rank averages from 31st to 33rd for the 3, 5, 7, and 10-year periods. Next slide, 18, Diligent 592. And so this chart shows that since 2004, a U.S. public equity composite that ranked 25th percentile every quarter for 10 years, that paid 27 basis points of fees, which is low, and were the SIC's fees in 2012, underperformed the Russell 3000 index. And so this means that a portfolio has to be significantly better than 25th percentile to beat the index after paying fees. So slide 19, Diligent 593. Now we've looked at the Russell 3000 index. This slide looks at active managers. And the table on the left shows that for the last 15 years, a diversified portfolio of median active managers has not generated meaningful positive net excess returns, 1 basis point. And this only includes the returns of the 42% of managers that survived the period. And the middle table shows that since 2012, a median manager portfolio would have underperformed by 40 basis points, and 64% of active managers survived this period. And the far right table shows that from the 15-year period to the 8-year period, in 23 of 27 style quartile boxes, net excess returns have decreased. So turn to slide 20, Diligent 594. This slide looks at the market, and the top graph shows that since December of 2016, the returns of the technology sector have been twice any other sector, and the bottom graph shows that the weight in the top 5 names in the S&P 500 is higher than 1999, and only portfolios concentrated in high growth, high momentum companies beat the index. So please turn to slide 24, which is Diligent 598. The current portfolio, U.S. equity portfolio, has approximately $4.1 billion in assets in 9 strategies, and 72% of the assets are allocated to strategies that take active risk, that is, are not invested in the market cap index. Slide 25, Diligent 599. But for this study, we evaluated many options and narrowed them to 3. 1, to continue the current defensive strategy. 2, a potential portfolio number 1 with a 68% allocation to the Russell 1000 index and a 32% allocation to the current high conviction managers. And 3, a 100% allocation to the Russell 3000 index. We are recommending potential portfolio 1 because the Russell 3000 index is a hard benchmark to beat. So we're allocating 68% to the Russell 1000 index. And to beat the Russell 3000 index, we're recommending to retain 4 current high conviction managers. Slide 26, Diligent 600. One thing I would point out about potential portfolio number 1, and it's number 3 on this slide, even though we think it's a good portfolio, there will be periods of underperformance. So 3C, for instance, the worst 12-month period in 2005 to 2006 saw all 4 managers underperformed considerably. Slide 27, diligent 601. Now, I'd like to make one point about the active managers. It's number 5 on this slide. The small cap managers, BlackRock and S&P 600, have a value tilt and are expected to struggle in a small cap growth rally, but these rallies are generally short. Slide 28, which is diligent 602. Now let's look at the metrics between the current portfolio and potential number 1. 3 points. First one, potential 1 has about half of the tracking error of the current portfolio, 0.65 versus 1.23. Number 2, potential 1 has a little more volatility. And third, potential 1 has generated most excess returns in up markets. So let's skip to slide 36, diligent 610. The estimated fees for the potential portfolio 1 are about half of the current portfolio, 8 basis points. And on 4.1 billion, 8 basis points is about 3.3 million annual fees. And for the last slide, 40, which is diligent 614, the recommendations are to allocate according to potential 1. This includes terminating 4 strategies, AQR, Brown Brothers Harriman, Donald Smith, and removing Scientific Beta from Northern Trust contract. And we're also recommending to increase the allocation range to the Russell 1000 index from plus or minus 5% to plus or minus 10%, because the allocation to the Russell 1000 index is increasing to 68%. And that concludes my prepared comments.
Thank you, Starla. And do we need to hear from RBK on this as well?
No, I think
okay.
We'll
Great.
take questions and all of us will respond.
Great, thank you. So just a reminder to committee members on the diligent page 614, one motion will encompass all of these recommended changes to the public equity, domestic equity allocation. So if I could have questions from committee at this time. Any questions?
Yeah, Starla, this is Tim.
Yes.
Dennis, is this your last of your spring cleaning? It looked like you
Tim,
cleaned everybody up.
I hope so. Good question.
It's all right.
Yes.
It looks like you've done work. It makes a lot of sense. Thank you. Thanks for all your work.
Thank you.
Any further questions?
Madam Chair. Madam Chair, this is Lee.
Member Rawson.
I certainly support Starla and the rest of the council's effort in this. My only disagreement is with one vote on the terminations. I just think, it's always been my preference to have singular votes, but I'll yield to the will of the chair. But I do think we're better to have individual votes. Thank you.
Yeah, we're going to keep it the way that it was proposed in the agenda. Anything further on this item? Do I have a motion?
Madam Chair, this is Linda Eidson. Based on the recommendations of the Council Investment Committee, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve the following recommendations for the SIC's domestic equity portfolio structure. Number 1, implement proposed manager target allocation based on potential portfolio number 1, 68% market cap passive, 14% factor-based, and 18% traditional active management. Number 2, terminate AQR Capital Management, LLC. Number 3, terminate Brown Brothers Harriman and Company. Number 4, terminate Donald Smith and Company. Number 5, remove Scientific Beta from Northern Trust's mandate. Number 6, increase the allocation range for the Russell 1000 index strategy from plus or minus 5% to plus or minus 10%.
I second. Peter Frank. Second.
Who is that? Okay. Member Frank?
Peter Frank. Yeah. Yes.
Yep. So we've got a motion from Member Eitzen and a second from Member Frank. Any discussion on the motion? We should have Carrie call the roll, please.
Commissioner Garcia Richards?
Yes.
Secretary Romero?
Yes.
Treasurer Eichenberg?
Yes.
Peter Frank?
Yes.
Linda Eitzen?
Yes.
Harold Lavender?
Yes.
Lee Rothman?
Yes.
Tim Jennings?
Yes, and I'm gonna leave the meeting now.
Mike Smith?
Yes.
And Nick Smith? The unanimous decision.
Okay, thank you, Carrie, and thank you to staff for this comprehensive recommendation. So we've made it through the bulk of our agenda. It only took us 3 hours. Yes, you have a question?
Yeah, Madam Chair, this is Tim.
Could
I just, point of order, I guess, instead of saying unanimous each time, Carrie, if you would you just tell us what the vote number is? You know, if it's 7-3 or 10-0? Because without the governor being present, the committee isn't full, so unanimous doesn't seem right to me. And I just a request on my part. Thank you, Madam Chair.
Okay, great. So we're going to go to Brent's report, agenda item number 5.
Yes, Madam Chair, this is Brent Shipp. I want to touch upon just 3 slides. I'll be as brief as I can. I'm on diligent material slide 614. I did want to point out on these talking points, as I've done in past meetings, item number 1, I provided the budget to actual schedule in your material through the end of May.
So that's
I don't
636 in my book. Is that, yeah.
All right.
Okay.
I don't know why mine's showing a different, okay, hold on just a second. Thank you for clarifying that. I can go back. 636 it is.
Mine also shows 614.
So does mine. So I think it's an update that didn't come through.
Okay, I think we'll 614 or 636 is my talking points, and because I'm going to only hit on a couple of slides, I don't think it's going to have that big of an impact. But I did want to point out that through the end of May, we're not anticipating any budget problems. We're almost through June. I did want to point out, I did go in recently trying to get ready for our fiscal year audit procedures and up the encumbrances for some of our investment managers by about $1 million, but that's not going to have any significant impact on the overall budget variances. And then I think Vince touched upon this. I did want to again touch upon the IHR and point out that the real estate, real assets, because of the valuation lag on those, we still have not seen March numbers. So just keep in mind when you're looking at these numbers, there's the potential for some adjustments. And as Vince pointed out earlier, this market right now is kind of hard to read. So just keep in mind that there could be some downdrafts in our future. And then on the agreed upon procedures, item number 3, we are completing the agreed upon procedures for the third quarter. I should have the reports for those, or the report for that period in by the end of June, and I will forward it to the full council. And then item number 5, I did want to point out, and I think this is kind of an update. Last month, the State Investment Council was notified by the Deputy Director of the Financial Control Division at DFA in May that the 5-year cap on the oil and gas emergency school taxes was reached. And because of that cap, we received $43.8 million in May to the Tax Stabilization Reserve Fund and $30.68 million in June. I did want to point out, and I'm not positive of the answer to this, we do, as part of our normal audit procedures, catch up for the lag from inflows from the land office. So actually, June's distribution doesn't actually reach us until September, and we do reflect that in the audit report. So I think for these oil and gas emergency school taxes, we still might have some additional inflows on those. And then
that is probably the case. Yep. We're
okay.
3 months behind.
Thank you, Land Commissioner. And then I'm on page 656 on the notes to the investment holdings report. I did want to point out, and I think the Land Commissioner will agree with me on this. I do note that the Land Office had an inflow of $93.5 million in May, which was a decline of $13 million. It says April, but it should be the prior May. I did want to point out that June's distribution, which will be for March, has not yet come in. I would expect a pretty sizable decline in that. And then for the 3 months that we're catching up on the lag, I would expect, sizable declines in those as well. So we all should be prepared for that. And then lastly, on my diligent material 658, I do have a memo on Invient. They do data and tax monitoring for us and daily capital call and distribution services. I do want to apologize to everybody for the delay in getting this memo to you. Invient was in during the first quarter before the lockdown. We provided them some input. They provided us some input. There's been some going back and forth. I did, however, feel comfortable in going ahead and recommending a renewal of their contract for another 4 years. Some of what they do is pivotal to what we do in our private assets, and we are adding some additional work for them, which accounts for the increase. But the total contract value is pretty small relative to some of the other contracts. It's $238,750, and I'm able to take any questions that anybody might have on the Invent.
All right, so let's start first with questions for Brent, either on his CFO report or on the recommendation for the contract renewal. Questions for Brent?
Madam Chair, I'd just like to say that I'm really impressed with the work that Brent and his staff do. I think that it's pretty amazing to keep track of all of the things that they have to do and do it so well. So my hat's off.
And you're absolutely right, Brent, that we're just seeing kind of the impact of the beginning of the fiscal crisis in the distributions right now, because the June will be the March.
Glad we're on the same page.
Into the land office, yep. All right, does anyone want to take a crack at the motion for the contract renewal?
Yes, I'll move the contract approval that Brent has proposed. It's Peter Frank.
I'll second that.
Very good. I have a motion from Member Frank to renew our contract with Invient, and a second from Member Lavender. Any discussion on that motion? All right, can I have Carrie call the roll, please?
Commissioner Garcia Richards,
Yes.
Secretary Romero,
Yes.
Treasurer Eichenberg,
Yes.
Peter Frank,
Yes.
Linda Eisen,
Yes.
Earl Lavender,
Yes.
Lee Rawson,
Yes.
Mike Messina,
Yes.
Nick Sayed.
Yes.
The motion passes 9-0 since Mr. Jennings.
Very good. Thank you, Carrie. Thank you very much. 9-0. Okay, great. Thank you very much, Brent, for that presentation. We're going to, yes. We're going to go on to agenda item 6, old or new business. Any old or new business before the committee?
This is Lee. I've got a couple questions.
Yes, Member Ross.
Earlier in the discussion, I heard two comments that I would just like clarification. One is that we would expect to see a more focused effort at renewables rather than traditional energy. And I just wondered what the basis of that is. What's the policy? Do we expect a greater return? Do we just think that's more the political position we should be in? Why are we doing that? And then I'm going to ask the second question because it's easier while I have it. What I heard was that the budget for FY21 was based on a $27.22 oil. And that seemed pretty low to me because I thought the expectation or the budget, at least for 2020, was $54. So certainly $54 is too high, but going into 21, I'm just wondering if I heard that right at 27 or if it was really a different number. So just a good clarification on those two, I would appreciate it. Thank you, Madam Chair.
Madam Chair, would you take those?
Oh,
Madam Chair.
Sure, I'd be happy to. Lee, the number on oil pricing, I believe, came from LFC during some of Don Iglesias' testimony. Charlie, do you have a different number than that?
Madam Chair. This is
Madam
Secretary Romero. Would you like to weigh in? Yes. Yes. And so the CRED number that they were using for oil is $31 a barrel. I confirmed that with our economist just a few minutes ago. Right, but that's the WTI, and the 27.22 is the net back price that New Mexico receives. That's correct. That's correct.
Thank you, Secretary. Lee, your other question had to do with the emphasis on renewables as opposed to traditional energy. The study that we have been asked to undertake as a result of House Memorial 9 will present to the Council a strategic plan for how the SIC can increase the renewable energy positive effects on the New Mexico economy. Other than that, there is nothing more specific at this time. I hope that answers your question.
And then Steve, it's Paul Chapman. I'm happy to add just a little bit to that, and that is that, you know, outside of New Mexico, we're also looking at renewable investment. And the reason we're looking at them is really twofold. One is we've identified the managers that we think can generate attractive returns for us on a risk-adjusted basis, and we'll probably be hearing from them in September on one of those. And then the other aspect is that we look at our energy portfolio, and we want to make sure that we have a diversified portfolio of energy businesses. So that includes the upstream investments that we have, some of the midstream assets that we have, some of the natural gas-fired generating facilities that we have, but also
making sure we have an adequate amount of diversification into the renewables space.
Okay, thank you.
Any further new or old business before the committee? So I would like to take this opportunity, those of you who did not join us for the investment committee meeting, I did bring a letter that the governor and I both received from a group that is known as Private Equity Stakeholder Project, and they were questioning an investment that we had done into Green Equity Investors Fund 5. It was sort of a critical letter about something that the Leonard Green investment company had done in terms of the dividends that they received from a particular medical company. And this letter is basically asking the state investment committee members to take action on this particular investment. Now, I do understand that where we are limited partners in investments like that, we don't have a lot of leverage in terms of say-so where investments go, which companies they go into. So I am proposing that the State Investment Council, in addition to looking at our asset allocation, doing due diligence on our investments, making sure we're meeting benchmarks, looking at fees, risk, and return, that we also start to look at, and I don't know if this is an ESG policy, but we start to look at doing front-end due diligence, especially on our private equity investments, to ensure that they are in line with the values that the State Investment Council holds and that New Mexico holds. And I'll just give you an example. You know, we have our state legislature has passed bills to increase investment in New Mexico companies, passed bills on criminal justice reform. Are our State Investment Council investments in line with those values? You know, we have a lot of public scrutiny into the investments that we make. And I think that with the $27 billion in the worth of the fund, we need to ensure that we are making equitable investments that align with our values. And so I would like to request that we take a look at either designing a policy, it could be an ESG policy, where we add into our due diligence when we're looking at investments, questions about the companies that are in the portfolios of the funds that we're investing in.
We'll be happy to take a look at that, and we'll get back in touch with the council on that point. Thank you, Commissioner.
All right, with that, a reminder that we have no July meeting, and so our next meeting is going to be on Tuesday, August 25th. I think we will stand by as to the form that meeting will take. And with that, we'll go to public comment. Agenda item number 7. Charlie?
Commissioner, Madam Chair, thank you. We have 2 short public comments today. The first one is from Gary Ferguson of El Prado, New Mexico. Gary writes, please consider adding a standing agenda item to share and discuss the percentage of the total SIC portfolio that is currently invested in New Mexico. Also, please ask the investment managers who present proposals information at the SIC meeting to tell us the percentage of their management and staff that live in New Mexico. Thanks for your consideration, Gary Ferguson. Comment number 2 is from Ken Segura Knoll. His message is, can you please add a link to any materials available to public on notices? Secondly, the SIC needs to look at an angel investment model to help New Mexico small businesses who are on the fence in deciding to open or not after COVID. Such an investment would be a match in investment with angel investments. It's from Ken Segura Knoll, and that is the end of public comments.
Thank you, Charlie, and thank you to the public for joining us on our YouTube channel. And thanks to the folks who submitted public comments. Do I have a motion to adjourn?
So moved, Harold.
Okay, we've got a motion by Member Lavender. Got a second by Member Eisen. Any opposition to the adjourning motion? All those in favor signify by saying aye.
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 Aye. Okay. With that, we are adjourned. Thank you, folks.
Bye, everyone.